Good morning, everyone. It's 9 a.m. live from the Nasdaq market site in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance Live, and here is your morning rundown. President Biden has arrived in Israel, and tensions are higher than ever. Palestinian and Israeli officials are trading blame after a rocket attack killed hundreds at a Gaza hospital. Biden's scheduled meeting with Jordanian, Egyptian, and Palestinian leaders was canceled in the wake of the explosion.
And we're wrapping up big bank earnings season this morning with Morgan Stanley. Now a tepid environment for investment banking weighed on profits, but it was offset to some degree by a better performance in trading. Also out this morning, consumer brands behemoth Proctor Gamble. The company beat expectations on profit, with higher prices offsetting a slight decline in sales volume.
And another day, another speakerless House. Republicans are planning to vote again today on their House leader after Jim Jordan failed to secure enough support yesterday. We're now less than a month from the government's shutdown deadline on November 17th. No speaker means no funding measures can pass the House.
All right, well, today's morning driver, we got to start with the move that we're seeing in oil, because oil is extending gains this morning as the crisis escalates in the Middle East following a deadly explosion at a hospital in Gaza. Now, Brent crude prices climbing to the highest level that we've seen this month on concern, or as concerns rise over a potentially prolonged conflict. We're also seeing Treasuries remain elevated after the 10-year yield steadied near a 16-year high. And you talk about everything that's going on right now, the movements that we're seeing related to the escalating conflict over in the Middle East, whether or not we're seeing a more of a risk-off type of trade here from investors in terms of some of the movement that we are seeing. But what's interesting when it comes to oil and the rise that we have seen in oil prices, yes, we have seen this movement to the upside, but relatively muted compared to some of the fears that we were initially talking about last week when we talked about the fact that we could be over $100 a barrel when it comes to crude. But we have a number of factors going into the price of crude, obviously, right now. And we take into account the fact that we have the weak refinery margins, we have demand concerns among those reasons, keeping prices in check. And we're still below $90 a barrel.
Yeah, and our own Ines Ferre was very apt yesterday to point out that this could become even more of an interesting scenario if Iran were to somehow get involved within the geopolitical tensions here because of their production and their output. Based on some information from the EIA, of course, the Energy Information Administration here in the U.S., Iran accounts for about 3.67 million barrels per day here. So that is particularly noteworthy, especially when you consider the output and then who's also purchasing that as well. And the share of the world total, Iran accounts for about 4% of that. Now, of course, the U.S. here and other countries, Saudi Arabia, Russia, really round out those top three and all in bring in about 45-ish% of the world total in oil production per day. So all of this considered, that's where it would get even more interesting if we were to see more escalation here. But as of right now, the comparisons that we've seen to the past, of course, there hasn't been that same type of massive spike that we saw when Russia invaded Ukraine, because that was, of course, at the time, the focus when Russia, given their oil production, 10% of the world's total production per day. That's what was in focus because of how there would be a kind of reallocation or redistribution of where that oil may be produced and who may the purchasers be, and the controls that they have in place to determine how much is going to be output per day as well.
Yeah, certainly we have Iran calling for an oil embargo against Israel following that attack on the airstrike on the Gaza, the hospital in Gaza. So that's adding to some of those fears when we talk about the fact that what is pushing and what has been pushing oil prices higher here. But again, relatively range bound when you talk about the number of factors that are going into the price of oil. Obviously, demand a massive consideration when you take into account what's going on here in the U.S., also what's going on globally, specifically also in China, exactly what that recovery looks like and what that could then mean for future demand down the line. But like you just said, obviously, U.S., a very important and growing presence when it comes to crude production here. So that's able to offset some of those fears that we're seeing overseas.
Absolutely. Well, staying overseas for a hot second here, President Biden arrived in Israel today, the first U.S. president to make the trip during a time of war. He met with Prime Minister Benjamin Netanyahu, pledging solidarity with Israel and supporting its accounts that the explosion at a Gaza hospital that killed hundreds of civilians was done by, quote, the other team. Our next guest sees some major risks the U.S. is facing by getting so deeply involved. Joining us now, we've got Kevin Barron, Politico Live Editorial Director. Kevin, it's good to have you here with us this morning to really add some more context around this. And from the top takeaways that you've seen thus far and also the top risks that are still present, what comes to top of mind for you?
Well, I think this is a pretty historic day with Joe Biden in the region for several reasons. One, historically, the U.S. and Israeli relationship has been rock solid, especially at the military and intelligence level, which I've covered for, like you said, about 20 years now. Whatever their political differences, that remains the same. That's all being tested. And I think we've seen in the last 5 to 7 days how Israel, at first, with it was being so upset by the attack, pledged to send the tanks into Gaza, invade Gaza, kick out 1 million people. Slowly get walked back by some really intense diplomacy by the Americans. But it still had huge effects. We see, as you mentioned, with the missile strike on the hospital that the Israelis claim they didn't do, that there's a huge public campaign around. It just shows how volatile the region is, where there had been progress in the region in the sense in the security world where Israel's neighbors have slowly over the years come to recognize the state, entered agreements with the state, Gulf, authoritarian leaders pulling away from the Palestinian cause. All of that is threatened to be halted and reversed as those leaders now are aligning with the Palestinian sympathies far more, of course, than Israeli sympathies, mostly because of the security leaders, because of Benjamin Netanyahu's iron fist rule that he's been known for and reelected for as in response, and by whatever comes next in the week following this visit by Biden.
Yeah, and Kevin, to that point, we know President Biden's meeting that he was supposed to have in Jordan with other leaders of the Arab countries here has been called off. Should we be reading into that at all, just in terms of what that could mean for a possible escalation in the war?
Sure, you can. Look, King Abdullah in Jordan called off the meeting, but that's the same king who makes almost annual visits to the Pentagon, is beloved by the American military and celebrated as a fellow frogman. He's a special operator. There's a real brothers in arms kind of relationship between the U.S. military leadership over the last 20 years who have operated so intensely in the region and Jordan's king. Politically, we see how limited those relationships can be when the Jordanians have to say, wait a minute, we're not going to stand next to Israel if they indiscriminately attack civilians. They will stand with anyone who goes after security threats. And they've done that with the United States, and they've done it in partnership or at least with permissions with the Israelis when they're fighting groups like ISIS and Al-Qaeda. So as the Israelis and the Americans have tried hard to equate Hamas as ISIS today, there's a difference between those wars, which were very targeted, very limited, special operations-led missions against specific fighters and locations, versus the kind of entry-level indiscriminate bombing, or maybe not indiscriminate, but very high collateral types of bombings that we saw in Gaza in the last few days.
Kevin, there was the early assessment that this was a conflict that could potentially be self-contained, but now as you have more world leaders making their own presences known here in the U.S., President Biden making a trip, but then also kind of bringing other world leaders like China into the conversation as well and trying to get them to condemn Hamas as well. How does that kind of impact the self-containment of the conflict?
Well, you just said it. The leaders are really trying to change the narrative that this is a battle against Hamas. It is not the Palestinians. So they've kind of, taken over that narrative from the Israelis, who are still, rightfully hot under the collar from the attacks, the initial attacks. As far as a regional war, look, I think Iran is not, not necessarily a rational actor, but they're also not idiots. They've received their share of intense attacks from Israelis using U.S. intelligence in places against, for example, their nuclear program. They know what would happen if they stuck their finger into this anthill. More likely, or I think a bigger possible threat that I'm concerned of are inspired attacks around the world. So when the ISIS campaign was raging, when the Al-Qaeda wars were raging, that's when we saw, people who were akin to that cause set off bombs and carry out attacks in European capitals, even in United States cities. The Pulse nightclub shooting, for example, California. There were mass shootings in the U.S. that were carried out by individuals inspired by the cause. We've already seen the attack on a boy and his mother in Chicago by one individual. So those kinds of terrorist-inspired attacks in city centers across Europe and the United States, I think, are probably the more worrying fear than any kind of actual military campaign that expands to include, Iran and the neighbors of Israel.
Kevin, bringing it back here to the U.S. and for President Biden and the Biden administration, how big of a test is this for President Biden when we do look ahead to 2024?
It's huge. This could be the largest foreign policy moment of his entire first term. Biden came into office pledging to have a summit of democracies. That kind of never really happened. There have been some meetings, but they couldn't pull it together. His age has kept him from really traveling the world as often as we might expect. And this is a big moment. I think, oddly enough, because it's a moment involving Israel, there's a lot of alignment on the Republican and Democrat sides that, the United States does stand behind Israel because, this is still a world that is governed by nation states, and a democracy in the region surrounded by authoritarians that is attacked is going to receive the support of the United States and European leaders. The German chancellor has gone there. Macron was scheduled to go visit. The British prime minister is scheduled to go visit. Where it comes into play for Biden politically, if you're looking to the campaign next year, today, Nikki Haley has an op-ed in the New York Post admonishing both Biden and her competitors as weak on foreign policy, not tough enough in the world, and wishy-washy, if you want to put it that way. But she only calls out Biden by name. And she says because of his Iran dealings, she kind of vaguely references rebuilding, that's code for rebuilding, not spending enough on the military, little things like that to make Biden seem weak, make herself seem like the strong foreign policy candidate, which is reverberating with voters, but in a hardline way. The last point I'll say, in the last week, there's been polling of the United States, and as always, with foreign policy issues, there's a huge divide between Democrats and Republicans. Democrats are showing far more sympathy for Palestinians. This was early last week, too, than Republicans. When I say far more, only 4% of Republicans said that they show sympathy with Palestinians, more than the Israelis. And it's more like 40% or so for Democrats. Just 4%. So Republicans really view this as a cultural divide, a religious divide, and they're not as anywhere near as forgiving. And so Nikki Haley again tweeted this morning, the only question that Biden should be asking of Netanyahu and the Israelis is, how can the U.S. help? That's a hard line that doesn't match with world sympathies right now.
All right, Kevin Barron, Politico Live editorial director. Thanks so much for taking the time and, of course, breaking down the latest on that President Biden's trip to Israel. All right, well, investors are looking to earnings season for bright spots amid a confluence of risk factors. Bank results generally held up thanks to higher rates, but the backdrop remains uncertain. Historically, October is the most volatile month for the S&P 500. So far this month, a lot of that turmoil has been in the Treasury market. Where the S&P is concerned, 4,200 is often cited as the next key level on the downside. Well, the big question right now is, have stocks been oversold, and is there a buying opportunity amid sustained risks? Joining us now is Keith Lerner. He's Truist Co-Chief Investment Officer. Keith, it's good to see you here. So we were just talking about the rising tensions in the Middle East when we talk about the geopolitical risk that is presented right now to the markets. You also have the surge right now in yields. What's, from your view, the biggest threat to equities at this point?
Yeah, well, Shauna, great to be with you and Brad again. It's been a little bit. So going to the equity markets, you talked about the tensions. We're using the word cross currents right now. I do think, as far as you think about what's happening, the equity market has been very resilient in spite of everything that's happened here recently. So as far as the main risk, I think it's two things. When you have something like this build up as far as geopolitical tensions, you have to say, what is this going to do to the global economy, and how does this manifest itself into oil prices? So I think, oil prices, as you talked about earlier, have rebounded off the lows, but they're actually below where they were as far as the highs just before the conflict. So I think that's something to keep an eye on. And then this 10-year Treasury, which normally during geopolitical times of tension, you see somewhat of a pullback. You're pressing against the cycle highs again for the for the 10 years. So those are the two risk factors that we're keeping a close eye on.
And so with regard to that, has that kind of triggered any major repositioning at this time, Keith, for what you're advising, what you're kind of looking across some of the broader asset classes and deciding that even with some of the risks that you've mentioned a moment ago here, that there should be some type of reallocation that investors think about?
Yeah, it's a great question, Brad. We haven't made any changes recently. Our big picture, because of all this cross currents, is our main call is we're strongly neutral across asset classes as far as stocks, bonds, and cash. And that doesn't sound as far as a big call, but in this environment we have a lot of back and forth. We think it makes sense. Coming into October, though, what we had told our clients, we still think we're in this choppy range for the S&P, around 4,200 on the downside, about 4,600 on the upside. The good news is we came into October the most oversold or stretched to the downside since fall. So some of the bad news has been reflected. And the other thing that I think where we can actually push a bit higher towards the top end of that range, even with all these tensions, is the earnings season. I think the earnings season is going to be solid. If you look at things like the Atlanta GDP now, that's around 5%. That may overstate the case, but still the economy has been somewhat resilient. Jobs over the last quarter have averaged above 200,000. So I think we'll see that reflected as we get deeper into this earnings season. And
talking
Brad,
about earnings season.
I'm sorry, go ahead, Shauna. No, I was going to say, if you wanted me to go more into how we're positioned within the equities, I can do that, but you let me know where you want to go next.
Okay, so we will get to that in a second, but I want to follow up quickly on earnings because so far we've heard from a number of the big banks. You take a look at their underperformance relative to the S&P more recently. I guess, what does that signal to you just in terms of how banks specifically are positioned and whether or not they're on much stronger footing than investors are giving them credit for at this point?
Yeah, I think overall the earnings for the big banks, it's been bifurcated, but so far they've been fine relative to expectations. But here's the notable thing about financials and banks. Historically, as you come out of a low, they tend to be leadership, like early cycle. Banks are since October of last year, where the market's up over 20%, are flat to down. So I would say banks, in our view, are just not the leadership group of this market. They haven't been the leadership. I think the best thing you can say is that valuations are compressed. There's a lot of bad news priced in, and earnings with those high interest rates have actually held in there fine. But again, I don't expect them to be leadership, nor do I think they need to be leadership for this market to grind a little bit higher.
And so, Keith, just coming back to that positioning that you were mentioning a moment ago, with all the factors at play during this earnings season, is there a theme that you expect to emerge that would kind of trigger some type of thought about which sectors investors should be weighted in the most?
Yeah, well, the first thing, even from a high level, as we think about global asset allocation with the geopolitical tensions, we've been Team USA for some time. All that's happening overseas reinforces that. And the one thing this time, too, the higher oil prices impacts consumers, but we also produce a lot of energy. That's a lot different than the 70s. So on a sector level, one of the areas that we still like and have been overweight for several months is the energy sector. It's one of the cheapest sectors in the market. Even if energy prices don't move a lot higher, as long as they stay somewhat stable, I think you'll see earning trends continue to move higher, and the companies are generating just a huge amount of cash flow. And then the other sector that we've been positive and remain positive on is the industrial sector. Part of that is the defense sector. We think there's going to be continued spending because of all these geopolitical tensions, especially as we move next year into an election year and we have a strategic battle with China even before this, and you put what's happening in the Middle East on top of that. We think those are two areas to stay overweight during this period of uncertainty.
Keith, just very quickly, I'm so glad you mentioned China because they did have Q3 GDP growth that really showed some type of rebound or recovery that is emerging here after the country had been talking about more stimulus that they needed to put into place, more projects that they needed to help fund for the next wave of investment coming from the nation into some of its core sectors here. For the companies that we're watching over the course of this earnings season that have the most international exposure, what can we expect for what they're going to say about China and how that's contributing to their business?
The thing with China today, their stimulus is a lot different than it was the last decade. It's more based on the consumer and less on the industrial side. So I think you'll probably see that bifurcation. I will say more broadly, we've been very negative on emerging markets, zero allocation over the last year in our portfolios that we manage directly. And even though China's trying to do these stimulus things and it's being up, maybe it gets a bounce. The issues right now is that corporate profitability is moving down. Like the earning trends relative to the U.S. is much weaker, and there's still a lot of regulatory actions and so forth. So our view is we would still be negative on China, even though it could have a bounce. And those companies, I think what you're going to see more and more within the S&P, companies are going to continue to diversify outside of China, specifically to other regions to mitigate some of the this battle that we're seeing as far as between the geopolitical tensions and so forth.
Keith, always great to get some of your insights here, and thanks for joining us this morning to kick off the show ahead of the opening cross here. Keith Lerner, Truist Co-Chief Investment Officer. Appreciate it.
Thanks, guys.
Thanks. Well, we've got just about 10 minutes until the opening bell. Let's see what the stocks are doing here pre-market. We've got Yahoo Finance's own Jared Blickery standing by here for us. Jared, we've got a heat map here internationally. We're taking a look.
Yes, it looks like the global indices more red than green, and especially in the U.S. here, where we're seeing stock futures down, the Nasdaq off about 63 basis points. I was just tracking the action over the last 7 days, and why 7 days? That covers that last week's inflation report that we got from CPI. Actually goes a day before that, but just in general shows you the market has been under a little bit of pressure. Nasdaq futures down 1.5% over those 2 days. Let's check out the Dow, which has been trading a little differently, not under as much pressure. You can see that's up just slightly, 0.3% there. But when we think about what's been happening, we cannot ignore what's been going on in the Treasury market, because the 10-year T-note yield has been screaming higher. It's only 1 basis point higher today, but you can see over this 3-month chart, the trend is from the lower left to the upper right. And as I've been talking about, when we have tumult in the bond market, that tends to spill over in equities because there's just not as much room for risk markets once you start juggling with the highly leveraged world of derivatives and fixed income. So let's check out some heat maps and see where we stand with regard to the sector action. Energy, not a surprise. We're talking about WTI crude oil and its volatility recently. That is up 0.5%. Staples also in the green pre-market, and then healthcare up just barely. That's XLV right there. To the downside, though, retail, consumer discretionary taking it on the chin, down about 0.75%, followed by real estate and communication services, industrials, materials, and the list goes on there. But let me just give you a picture of the Nasdaq. Now, the background, by way of comparison, is yesterday's closing price, so that is what the heat map is reflecting there. Then those little rectangles are what's happening today. Apple, you can see, down about 81 basis points or 0.8%. Microsoft up slightly. Not seeing a whole lot of action here. Do want to track the semiconductors, because NVIDIA here, it was down 4.5% yesterday, down another 2.69% today. I've been checking out the range that it's been over the last 3 months. Still not really in the center of that range anymore. Kind of sold off and is heading down to the lower end, but still just in a trading range. Chips in general have been taking a little bit more of a hit than software, as they are more cyclical. And let's just pull up software here real quick, and we can see more red than green, but Microsoft up about 22 basis points in the pre-market, guys.
All right, a couple of names that we're going to be keeping a close eye on. Jared, thank you. We'll keep right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Let's take a look at some of the individual movers that we have this morning. We got to start with Procter Gamble, the company topping earnings revenue estimates and widening its outlook on fiscal revenue in 2024. Now, P&G saying that they're projecting a 2 to 4% sales growth here. We talk about the fact that that's a bit of a wider range than what we had initially gotten from Procter Gamble. They had initially been forecasting growth of just about 3 to 4%, so a bit of widening out here. But what's interesting to me when it comes to these consumer staple plays, what we're hearing from names like Procter & Gamble is that they're still able to pass through some of that higher pricing pressures, right? Yep. They're able to charge customers a little bit more. Yes, we did see a drop in volumes. That was the 6th quarter in a row that we did see a bit of a dip when it comes to volumes declining, but they are able to offset it, at least for now, with higher prices. In terms of what that commodity picture, though, looks like going forward, they do see a bit of a tailwind when we take into account that some of these commodity pressures are easing just a bit. So yes, that would be great news here for their business going forward. But again, it's been an issue here that Procter & Gamble, many of its rivals, have been dealing with now for quite some time. But Procter & Gamble this morning saying that it sees an $800 million tailwind to profits over the next 9 months due to lower commodities. Yeah,
I think for any of our viewers, any investors that are looking at Procter & Gamble or other names in this space, what you can often look to, especially when they report earnings, is if the volume is down and the sales are up, then prices are probably up as well here. And that's exactly what played out, as Shauna was mentioning a moment ago. Prices were up 7%, so sales were up 7% here, but this was all despite volumes sold being down 1% here. And there was a little bit of correlation within this report to what we had seen within the monthly retail sales report that came out too most recently, where you still did see this kind of 9-month total year-over-year change of about 7.9% in some of the health and personal care stores. And healthcare, the pass-through here that you would look to or be apt to look to within the results or segments net sales drivers from Procter & Gamble was that healthcare saw the biggest net sales increase year over year. That was up 11% net, but organic sales up by about 10% there. And so that's where they were also continuing to pass through price. Volumes were up by about 2% there. To all that considered, people continuing to lean into health. However, there is some cyclicality to that year over year. You look at this quarter, especially in that back to school season, and then once you get into some of the winter months where people are more likely or have more propensity to spend on some of those healthcare items as well.
Yeah, it's going to be important to look at buyer behavior and what people are spending on, what people are not spending on, because you mentioned the fact that we did see volume growth here for the healthcare division, the only segment to report volume growth here for the quarter, but we did see certainly a pullback in a number of its other divisions, namely fabric and home care business, some of those home cleaning products. That shrank volume there by about 1%. So it's important to keep an eye on some of the pricing action that we're seeing from these consumer staple companies, and then what consumers are doing as a result.
I'm wondering what the beard oil replenishment rate is for those out there who are growing out their beards going into the winter, because the grooming was down by about 2% on volume, at least. Net
Maybe
sales
they're cheaper options. I don't know.
Cheaper options, or I don't know. I'll ask Jared Blickery about that. Neither one of us have beards, but hey, should we decide to grow them out for the winter?
All right, well, keep it right here on Yahoo Finance, because our very own Brian Sozzi, he's going to be sitting down with the CEO of Procter & Gamble, John Moeller. That's at 10 a.m. Eastern time this morning.
Yeah, Sozzi doesn't have a beard either. Neither does John. All right, well, somebody's going to get these beard oil questions.
Know a little bit more. No, maybe you guys can speak from past experience. All right, well, we got to get to the opening bell here on Wall Street. Some movement here at the open. Jared Blickery standing by with a look at what we're seeing on a sector basis, Jared.
Yes, for the record, I once had a mustache. Management asked me to shave it off. It was that bad. I'm not kidding. All right, let's focus on...
It didn't happen, Jared.
Let's focus on the sector action of the day. XLP, that's Staples, that was in the lead, kind of switching places with XLE, that's energy. Healthcare and utilities also flashing green, although utilities look like it's unchanged at the moment. Materials, consumer discretionary, and industrials are rounding out the bottom here, and that means cyclicals are under a bit of pressure. Energy can be considered either a cyclical sector or a defense sector, depending on how you look at it in the stage of the business cycle, but it tends to be defensive at this stage of the business cycle when the Fed is tightening and oil prices are still going up and haven't rolled over yet. Here's our leaders in sentiment index, and we see TAN, that is solar energy, that is in the forefront. That's up 1.5%, followed by IPOs, small oil play there, gambling, meme stocks, defense. To the bottom, we have gambling. MJ is under the most pressure, down about 2%, followed by chip stocks. And it looks like home builders and Chinese stocks, those aren't doing as well either. Let's take a look at the Chinese names. Alibaba down 1%, Pinduoduo just flashing a little bit of red there. Xpeng down 3.5%, but more red than green. Let's get a change of pace and check out what's going on in the oil patch. Energy earnings on deck here, but not until we finish with the financials. Exxon up over 0.5%, Chevron up 1/3%. Looks like BP flashing a little red there. And Chesapeake, after the announcement of an acquisition, down about 0.75%. Difficult to see, but right down there in the lower right. Let's check out some bank earnings as well. Morgan Stanley, a little bit of disappointment there, down 5.7%. State Street up 3.8%, but JP Morgan and the rest of the crew here largely flashing a little bit of light red. Let's call it light red to start the day. And we're going to take a look at the travel sector as well, because we got United earnings and having some trouble with costs. Three dark squares here: Delta, United, American. And we're going to pull up United and just chart the year-to-date price action here. We are back to break even. So United had been up to about $55, $56 per share, has given back the year's gains, guys.
Wow. All right. We're going to continue to have a discussion on the airlines in just a moment here, but we do want to come back to something that Jared mentioned in Morgan Stanley, because we're tracking those shares this morning, as he mentioned, down by about 5.5% right now. The bank releasing its third quarter earnings, overall profit falling 9% from a year ago, but beating Wall Street expectations. A tepid environment for investment banking weighed on profits, but it was offset by a better performance in trading. The bank is in the middle of a leadership transition. The CEO planning to step down by next May. A successor has yet to be announced. We have some of the quotes that are coming out from the call, which has already begun as of the beginning of this hour here, and got commentary from James Gorman about even where the pathway for the Fed looks like here. The minute you see the Fed indicate they're going to stop raising rates, the M&A and underwriting calendar will explode, Gorman says, but also expecting one more rate increase by the end of the year and not expecting them to cut in 2024.
Yeah, he's pretty bullish just about what that deal-making activity could potentially look like when you look ahead into 2024. Of course, like he's saying, a lot of that hinging on the activity that we see from the Fed and exactly what policy shapes up and looks like in the new year. Coming back, though, to what you said about succession, because I think that's a huge question here for investors, for analysts. Who is going to take over once Gorman does retire? And it was interesting because he did say that essentially, hey, he's ready whenever the board feels comfortable for him to leave. He wants to leave at the earliest, or I would leave at the earliest moment that the board feels comfortable. When it comes to those successors, who exactly it's going to be? It's two names likely that have been talked about a lot. You talk about Ted Pick. You also talk about Andy Saperstein, the co-presidents of Morgan Stanley. I would say lately, maybe Pick largely viewed as that front runner for the job. But again, that's a huge question mark for investors, for analysts, when we take a look at what the direction of Morgan Stanley is going to look like here going forward. So again, we're seeing some pressure on the bank here this morning. Wealth management revenue was a bit below expectations at $6.4 billion. We mentioned the lack of deal activity there. Yes, Gorman's bullish about what it could look like down the line, but the lack of deal activity weighing on investment banking revenues in its most recent quarter. That was down 27% from a year ago. And then, of course, fixed income net revenue down 11% compared to the numbers that we were seeing a year ago.
All right. Somebody's going to have to get rid of that stock of Vegemite that's in his office if he does leave anytime soon. That's one of the more noted, interesting, fun facts about James Gorman. Yeah.
I did not know that.
Yeah, Business Insider.
Well, someone has on that job. All right, let's talk about another mover today, and that's ASML. Shares falling as the chip maker warns of flat sales in 2024 because of weakened consumer spending. Now, ASML's Q3 earnings beat analyst expectations, but the company did say that they expect 2024 to be a transitional year and predict that significant growth is not going to happen until 2025. Well, NVIDIA, another chip maker in the news this morning, Citi lowering its price target to $575, but maintaining its buy rating. The move coming after the Biden administration announced fresh U.S. export restrictions blocking the sale of more advanced AI chips to China. So exactly what this means for the broader chip sector. We talk about the fact that obviously we have seen a slump, more broadly speaking, not necessarily for NVIDIA, but more broadly speaking in the chip sector, what exactly that rebound looks like. First, when it comes to ASML and some of the numbers that they put out, plenty of reasons for concern here. Bookings falling 42%. It was the lowest quarterly intake that we've seen from the company since 2020. Revenue missing expectations for the first time in 7 quarters. So consistent with what we've seen from some of the other players within the space. We know earlier this year, ASML did say that it does plan to slow hiring amid the downturn that it's still experiencing. And then, of course, the restrictions announced by the U.S. this week, adding to some of the concerns within the sector.
Yeah, just taking a look at some of the year-to-date performance here. The company's still holding on to gains of about 6%, but you think about the larger semiconductor industry and some of the gains that, if you pit them up against an NVIDIA, nowhere close to what NVIDIA has been able to do, and some of the other chip-making companies that have amassed these huge shareholder returns over the course of this year. And even as you think towards the going forward strategy for them in this broader environment, and what Foxconn had even come out and said with regard to companies in this chip making realm that are trying to be able to take advantage of the demand for AI, but are perhaps a little bit behind the 8 ball in terms of the other competitors that are out there that have gotten ahead of the game, either through investment or through homegrown strategies. For ASML, not just the geopolitical impact here that's going to impact some U.S. companies, but also just their own ability to jump or leapfrog some of those others that have gotten a head start either through acquisition or through some of their own R&D that's been able to move forward swiftly as well here. Also, let's talk a little United Airlines this morning. Excited for this one. Let's go to the skies here. Beating Wall Street estimates. Third quarter results came out, but the company grounded expectations for its fourth quarter. The carrier saying the Israel-Hamas war and rising fuel costs may impact fourth quarter earnings. United saying if flights are only suspended to Tel Aviv through October, then they expect to be on the high end of ranges. If they remain halted for longer, they'll be at the low end. More on this. We've got Steve Trent, Citi airline analyst. Steve, want to get your take on what United had to say for the quarter.
Yes, good morning, and thank you for having me on. So I do think that looking at the outlook for the fourth quarter, excuse me, and probably what we can see going forward, demand indications still look very good. International on the transatlantic and trans-Pacific look very strong. They're getting good traction in the domestic market. I think when you have this issue with the suspension of the Tel Aviv flights, it creates a tough situation for any carrier. If you just pull the plug on revenue, that revenue disappears, and fine, you don't pay fuel for that corridor, but you still have to pay your employees, and you still have to finance aircraft. So it's not like your costs also disappear. But that does not strike me as a structural item. That strikes me for now as a temporary item and not something wrong with the strategy.
Steve, even though it is a temporary item, we know that United has the most flights or had the most flights going into Israel of the U.S. Domestic airlines. How big of a hit, even if it's just temporary, I guess, can you quantify it for us? What exactly does that look like in terms of the headwind for United this quarter?
Yeah, sure. So if one looks at the what they mentioned about the fourth quarter, it looks like the company's telegraphing a 15 cents per share hit for every month that the Tel Aviv flight suspension is in effect. That would be for the fourth quarter per se. When we think about what that potentially means for 2024, I'd be deeply reluctant to apply that same math, because that would assume that if, heaven forbid, this does go on longer, that United has no capacity to redeploy those flights and crew members and generate revenue somewhere else. So I think that 15 cents per share monthly impact is specifically pertaining to 4Q.
Are we beginning to see any pushback on prices from the consumer, Steve?
Certainly an international long haul, from what we can see, the answer is no. Even in the domestic market, where United, let's say, has a more diversified, more robust product than some of the domestic discount carriers, relatively speaking, the answer to that also looks like no. And when we think about capacity deployment, now versus 2019, there's roughly 28 some odd dollars of U.S. economic activity per available seat mile. That's relative to 24 some odd dollars in 2019, according to some work we did recently. So broadly speaking, and from a revenue standpoint, we would not say that there's an overcapacity situation. So based on consensus, this is a carrier that's going to earn close to $10 a share this year. That's wildly better than it's done over the last 3 years. And the street is, at least today, not giving them credit for that.
Steve, what does this tell us more broadly speaking about the airline industry, how it's positioned? We're going to hear from American tomorrow. Is it going to be a similar tune there from some of the other large domestic carriers?
Yeah, so I think from the industry level, we have a couple of prints coming out here, of course. We expect the international long-haul network carriers to continue presenting better results than some of the domestic side, especially when we think about the divide between network airlines and discount airlines. We would say relative to 2019, the fortunes of those two groups have sort of flipped. So international long-haul, transatlantic, and transpacific, we see a lot of momentum at the moment. And relatively speaking, some domestic corridors have somewhat harder comps because the last 3 years, places like Florida have been almost the only places that have been open. And now they're not the only places open. And then beyond that, when we think about the migration of the network airlines towards more direct channel sales, and maybe even a migration towards economy plus from main cabin, relatively speaking, all of those factors, plus the stronger pricing power, are still going to help the network airlines better than more than the discount airlines.
Steve, just to follow on that, for American Airlines, I mean, this company is down over the past year by about 16%. Here, during today's trading activity, has just struck a new 52-week low. What do you think investors need to hear from American Airlines in order to give the all clear that there is a trajectory or at least some type of trough that is set in?
Sure. So let me give you an industry answer on that one. When one looks at the various nuts and bolts of a network airline, versus a discount carrier, certainly we want to see that revenue momentum is there. I think we've absolutely seen that with United Airlines. I think, secondly, when we think about revenue relative to cost, it's fine for airlines to cut cost, but you need the horse to pull the cart. Who cares if the cart's lighter if there's no horse to pull it? So I think, those carriers that are having a tougher time on the cost side, I think we're going to see some question marks around that. And then certainly debt load. There is I would say, a very important difference in the group in terms of what's happening with financial leverage. Certainly, interest rates are going the wrong way for those carriers that are highly levered. And we'll see what that picture looks like over the next couple of quarters, considering to the extent to which some of these names may have to refinance.
All right, Steve Trent, always great to get your perspective. Citi airline analyst. Again, we're looking at United shares off just about 7.5%. We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. All right, China's economic growth slowed in its third quarter, rising by 4.9% year over year, but still beating expectations thanks to increased consumer spending. While government stimulus boosted consumption in the world's second largest economy, the property sector continuing to drag down growth. Now, while China may be getting back on track to hit its year-end growth targets, ongoing trade disputes between China and the U.S., as well as rising geopolitical tensions, could begin to weigh once again. According to our next guest, large swaths of the domestic and global economies could be fundamentally weaker than top-line numbers suggest. Let's break down what all this means for investors, for the broader investor landscape. For that, we want to bring in Scott Sperling, Thomas H. Lee Partners co-CEO, THL. Scott, it's great to see you at Yahoo Finance. Thanks so much for taking the time to join us. So let's start with what has played out over the last week and a half, the growing escalation or threats here in the Middle East amid the war between Hamas and Israel. From your assessment, how big of a risk does this pose to investors in terms of what that opportunity could look like, or the challenges that could present in the coming months?
I think my assessment of the potential risk may be greater than seemingly the market has, which has not reacted all that adversely to the horrific events of the last week or so. The danger now geopolitically, I think Jamie Dimon made the appropriate comment, is the worst we've seen in our lifetimes. And as we think about trying to do business in that environment, and what the implications are for commodity prices of all sorts, for supply chains, and then just for fundamental demand for commercial as opposed to military goods, I think it raises all sorts of questions. Now, beyond that, we've obviously gone through a period of lots of firsts. Start with the entire COVID crisis, the complete shutdown of our economy, followed by massive fiscal and monetary stimulus that helped put us back on the right footing. The miraculous work, I would say, of our life science and healthcare sectors to deal with the health problems all put us in a place where we saw a massive run-up in the value of the equity markets, and correspondingly, even with the collapse of occupancy in the real estate market, for a long time held up the value of real estate, particularly residential real estate. I think all of those things are starting to unwind a bit. We've seen that in the adjustment to earnings expectations over the last 7 or 8 quarters, where the expectations have come down. We seem to generally meet those lowered expectations, but the trend has been obvious. The cost of capital has gone up dramatically. That has a way of working through the economic cycle with a number of different lags. And so I think we're starting to see the impact there. And the long-term outlook from a fiscal perspective is, to say the least, uncertain. So all of those things, I think, create levels of risk. Offsetting that is, again, amazing technology in both the life science side, and as we've seen with the movement in generative AI, that is so much faster than anybody expected. The technologies there can create opportunities in both places that have yet to be explored.
Sure. Okay, a couple things we want to unpack there. First and foremost, when you say high likelihood of a business recession here, you've got CEOs, especially from some of the largest banks, giving their kind of weather forecasts about the economy right now. And the latest coming from Morgan Stanley CEO this morning, saying that he does think the Fed is going to do one more rate increase by the end of the year, doesn't expect them to cut in 2024. What does that signal to you, if we were not to see a cut in 2024, about the likelihood of that recession, and ultimately if this higher for longer has a larger impact on the depth of a recession?
Well, higher for longer should theoretically have an impact on what the value of any given asset is, clearly. And, you know, we saw that with a collapse in mostly technology stocks, but stocks of all sort about 18 months ago, as people were coming to grips with the fact that inflation was not going to get defeated easily, that the Fed's job was very difficult, And I think now you're looking at a situation where not only is the Fed probably going to have to retain these higher rates longer because of the nature of inflation that we're dealing with, but the fiscal deficits are so large that the supply and demand equation, particularly as you look at the 2 to 10 year tranches of Treasury debt, we're just going to have an enormous amount of supply being put into the market, and it's not clear the demand will meet that unless you see higher long-term rates be sustained, even past the point that the Fed may start to bring down the near-term rates.
So, Scott, it sounds like you see a reasonable possibility here that rates are going to stay in this elevated range. Is that correct?
Yes. I would agree. I would agree with a number of I think, both banking leaders, but also business leaders who are seeing the same thing, which is, we're not fully defeating the forces of inflation. The wage push inflation that we see coming from, maybe appropriate demands, particularly from the union side, for double-digit wage increases over the course of the next 3 to 4 years is not abating. There are still a number of areas where there are labor shortages. And again, I think while technology can help solve some of that, it's going to take some time.
And then, Scott, to that point then, when we talk about the consumer right now, obviously consumer has been extremely resilient, pointed to in many instances as one of the reasons or one of the main reasons why the U.S. economy has been able to avoid this recession. If we are in this higher for longer elevated rate period here going forward, what is then the impact on the consumer and just what that would mean in terms of weakness that we could see more broadly speaking?
Well, I think you're starting to see, two facts emerge. One is that the massive amount of fiscal stimulus, putting money in the pockets of consumers, is starting to run out, and that's going to have an impact. The second fact is that you're seeing a massive increase in consumer debt, particularly credit card debt, and that obviously has a depressing impact on future purchases, particularly given the high rates for lots of different types of consumer loans, even putting aside the extraordinarily high rate of credit card debt. So I think those things will tend to dampen at least the growth of consumer demand going forward, and in many cases may actually bring it down.
Scott Sperling, Thomas H. Lee Partners co-CEO. Scott, thanks for taking the time this morning.
You're very welcome. I wish I had better news for you in any regard.
Soon, very soon, hopefully, Scott. We'll work on that too for you. Thanks.
Thank you.
Well, switching gears here, Congress has less than a month to get a funding bill approved and through both houses or risk a government shutdown with no speaker in sight. Lawmakers' hands are tied here. House Republicans are set to vote again today after Congressman Jim Jordan failed to secure enough support yesterday. Yahoo Finance's Rick Newman, he joins us now with more on this. Rick, what do we know? What are we tracking? When's the next vote?
Well, this vote today on Jim Jordan again seems kind of pointless because he didn't even come close to getting the speakership yesterday, and many analysts think there are going to be even more no votes against him today. So it's almost like just a pro forma exercise, I guess, because the House has nothing else to do, so they may as well fail to vote for another House Speaker. Why not? But the plan that's coming in place now is for the interim Speaker, Patrick McHenry of North Carolina, the guy in the bow tie, to sort of become the caretaker House Speaker. So he doesn't want the job. He doesn't actually want to run for Speaker in its own right. But there is a way that he could sort of be empowered to be the Speaker pro tem, which would allow him to do more than he is able to do now by the House rules. He would be allowed to bring legislation to the floor so the House might actually be able to do some legislating and vote on some bills. And that seems to be sort of the last resort here, because there's nobody who seems like the Republicans would be able to elect as a permanent speaker. So if this plan for McHenry actually works, over in the Senate, they're saying, you know what, we're sick of this. we're going to put together a big bill that's going to have Israel support, Israel aid, Ukraine aid, Taiwan aid, and some kind of border funding. A big bill. It could be $100 billion or more. We're just going to put it together, and then we're going to send it to the House, and they're going to have to figure out what to do with it. So that might be a forcing function that gets the House moving, or gets the House Republicans moving. And then, of course, we've only got less than a month now before those temporary spending bills run out in November. So the next big question is, if they can get some way that allows them to function, the House Republicans, will they be able to address these bills? So we've got drama built into the calendar for basically as far as the eye can see for the House Republicans.
You know, DC normally delivers when we're talking about drama. But Rick, real quick, just a follow-up question just in terms of what the extent of the power that McHenry would potentially have if, in fact, this does happen. Does he essentially have the same power as a speaker would then under this situation?
So this is an arcane question that we've never really had to deal with before. Yeah. So I have not read all 17,000 pages of, the House Rules Manual. But they would, the sort of experts on this would have to adjust the rules so that, they would have to change some rules. They don't have to change the Constitution. It's not a constitutional amendment. It all has to do with the way the House works. So it appears that they can change the rules enough for Congress to address the things it must do. And then if they can do that, let's say they get those spending bills passed and the government is funded for the next year, then they might actually try again to formally elect a speaker or some point in 2024. What would change that would give somebody the ability to get all but three House Republicans lined up? I have no idea. But let's just get to tomorrow with these guys.
Yeah, certainly. No shortage of drama down there, especially about what's happening right now, the division within the GOP party. All right, Rick, thanks so much.
Bye, guys.
Well, we've got all your market action ahead live from the Nasdaq market site. Keep it right here. You're watching Yahoo Finance. Welcome back to Yahoo Finance Live. I'm Shauna Smith alongside Brad Smith. We're coming to you live from the Nasdaq in New York City, just about 30 minutes into the trading day. And let's take a look at how things are shaping up. Some broader pressure across the sectors today, but Abbott Labs shares are on the move. They're actually moving to the upside. Now, the healthcare company reporting its Q3 earnings today, tightening its forecast for the rest of the year. Abbott beating estimates for its third quarter. Now it's citing strong demand for its diabetes care products.
Now looking at ARM shares, KeyBank rating the company as overweight with a $65 price target. The firm saying that ARM will benefit from technology becoming more demanding and complex, and the industry will rely on their processor designs. This comes after the U.S. tightened chip exports to China in an effort to control the country's AI progress.
All right, Viking Therapeutics stock lower this morning. The drug developer throwing its hat into the weight loss drug ring. An early stage clinical study of a drug showing promise in weight loss and reducing liver fat levels. So you're seeing still low pressure off just about 1.5%. All right, well, we are well into the third week of the war between Israel and Hamas. Now, following a deadly missile blast on Tuesday at a hospital in Gaza, protests have broken out across the Arab world. Now, President Biden is in Israel amid the growing unrest and has supported Israel's claim that the blast came from, quote, the other team. Our next guest has insight into the current situation on the ground. Joining us now from Tel Aviv, we want to bring in retired Colonel Miri Eisen, Managing Director of the International Institute for Counterterrorism at Reichman University. Colonel, it's great to see you. Thank you so much for taking the time. Give us a lay of the land in terms of what is currently happening right now, and given the escalating threats among those outside of Israel and Hamas, what the next couple of weeks could potentially look like.
We're still inside a war. We're still, as a country, mobilized in war. That means that we are continuing to try to attack as much as we can the Hamas targets that are inside the Gaza Strip. But I want to share with you all that I just came back from one funeral of a couple, a mother and a father, who were murdered in their house a week ago Saturday, and it's taken 12 days until they could be buried because these terrorists 12 days ago so mutilated, torched, burnt the different bodies. It's taken us an enormous amount of time to be able to do that one Jewish thing of burying quickly. They can't be buried where they lived because these towns, villages, and agricultural communities were burned and pillaged. So when you ask me what's the next, I want to remind everybody that we have a country here that is bleeding. 1,400 people were murdered, and part of what's going on are the funerals and just immense amount of families and the hostages. When we look at the battlefield in that sense, this is not a war of once upon a time. It is unprecedented. We are trying to go against a horrific terror organization. It uses the entire Gaza Strip as its own human shield, using the hundreds of hostages that they took. So in that sense, what we're looking at is the potential of a ground operation to perhaps be able to get to the hostages, the growing tensions on Israel's northern border, Hezbollah, Hamas's older brother. This is very challenging times. President Biden coming here today, for all of us, it is the amazing thing to see this amazing American support.
Colonel, you're absolutely right, and we're sorry to hear about how this has hit home for you as well and your friends and family. And we know that so many out there grieving right now or trying to find family members, and with all that, the human toll certainly still front and center here. With regard to what you were mentioning about some of the world leaders as well, what response would you like to hear from other world leaders with regard to what they can do to curtail and stop the attacks from Hamas?
What a wonderful question. It's also what you can do in that sense. We're a country, we have our warts and blemishes. We are a moral Western democracy. And over the last 24 hours, I have been talking with different media, and this has to do also with governments. I have seen the governments question Israel that we would think of attacking a hospital. Everybody bought up and in a knee-jerk reaction blamed Israel because Hamas said that we attacked a hospital. We had to prove that we didn't attack a hospital. What I want to hear in a clear voice from world leaders, and I've heard that from President Biden, is that we understand collectively, this isn't just the higher moral ground. We are talking about impossible events that Hamas are doing and continuing to do, including blaming us for the hospital horrific explosion. I can feel as bad for those people there as anybody else. But to automatically jerk knee and automatically blame us, no, we need the people to stand up and to understand that we are in a horrific war. And in this one, it's against Hamas, and they don't play by any rules we can think of.
So to that point then, Colonel, I guess, do you see then pressure to declassify some of that information in order to maybe clear up any information that needs to be or should be released to the public. And then to that end, when we talk about President Biden visiting Israel right now and the role that the U.S. is trying to play in stopping a further escalation of this throughout the Middle East, are you confident that President Biden and his administration are going to be successful and able to do that?
So I'll address the first issue. We already declassified the information last night. We've already put out both the voices of the Hamas operatives saying that that was not an Israeli, that it was the remnants of a of Palestinian Islamic Jihad rocket. We've already put out the different information, and President Biden himself said to his own people, and it came out in the press, that his own people at the Pentagon have also said that they have the hard evidence that it wasn't us. But you do realize that that means that we have to prove it, that you're willing to accept the premise that we would attack a hospital. I'm appalled by the willingness to accept that framing at all. So that's the one thing. When it comes to President Biden on the ground and the continuation, he's come in here, he's done something very exceptional. He, like also Secretary of State and the Secretary of Defense who have been here over the last few days, participating with the Israelis in different cabinet meetings. You know, here in Israel right now, we all live a very odd life. It's a war life. It's not, people are not really working, that you don't have regular schools. At the most, there's stuff that's done by Zoom. We're 10 million people, where we've had hundreds of thousands of Israelis who have been dislocated and cannot go both to the communities that were destroyed down south and to communities that have been preemptively evacuated up north because of the possibility of Hezbollah. So I think the President Biden, having come in, has been showing both the heart, which is amazing, but also in giving the backing and giving the understanding, in looking at these different threats and making us not just feel stronger, but jointly go against this horrific terror organization.
Colonel, we understand that President Biden is actually delivering remarks right now, speaking right now in Israel. We just want to continue to acknowledge that, and we've got a view of that for our viewers in the bottom corner of their screen. You know, what makes this so much different than any type of conflict, any wars in the past, is that it's also taking place during a time of social media and where there is just a trove, and unfortunately so, of misinformation that takes place at a time like this. And so all the more important to understand how people are getting their information and where they're hearing accounts coming in from. Where are you advising, especially for some of the people that are top brass on many different sides of the globe here and areas of the globe that are trying to get their information? How does that typically transpire? How does that typically take place, and blocking out some of the noise that takes place as well?
Hamas have been for many years on social media, in social media. There's the one aspect of what they say to the Western, mainly English-speaking world, and what they say in Arabic and other languages to the Arabic-speaking Middle Eastern world. When I say that, that means that they immediately put out, it's all psyops. They put out lies, misinformation, disinformation, and everybody goes, how can I know? They are a terror organization. Take note of what the source is. What Hamas did on Saturday, I'm even wary of saying it, but I want to share with people. They live streamed on Facebook, taking over people's phones and their Facebook accounts. The Israeli citizens, they live stream how they were killing these people while their families on Facebook were watching people live stream being butchered. I want to hope that rational people, understanding people, understand what that means, these terrorist psyops. It's done, when I say the psychological operations, it's done in the way that they took the hundreds of hostages, of using them in such a manipulative way. But they have been using the social media to stream their victory. So on their side, in Arabic right now, they are showing edited films that they're being nice to babies. Oh, they're not showing the 40 babies that they burnt to death, the babies that they decapitated, and they filmed that as well, only they didn't post that part. We have to be very wary of what we look at. The images are incredibly hard. I'm telling people, when people send things to you, breathe in deep, make sure you have a warning. Some of it is impossible to see, but this is what inhuman beings did last Saturday and Sunday inside Israel, and this is what we're trying to attack. And the social media festers. And so we really need to be on board, question, look, see what the source is, see what the data is, see that it's not edited.
So important to verify where your information is coming from. Colonel Eisen, once again, we are so sorry for everything you and everyone affected by this war is going through and has been going through over the last several weeks. Thanks so much for taking the time to join us.
I really appreciate being here. Everybody should stay safe.
We want to move on to another story that we're closely following. That's the latest that's going on in the housing market. So if you're in the market for a newly constructed home, there is some encouraging data out this morning. Construction of new U.S. home sales did rebound in September, up just about 7%. Now, this comes after a 1.5% decline in August. Building permits, though, that dropped just about 4%, signaling a drop of future construction. So what does this mean then for the future of the housing market here in the U.S.? Lawrence Yun is the National Association of Realtors chief economist. Lawrence, it's good to see you. So when you take into account what we're seeing in terms of housing starts, exactly what's needed on the demand side and the supply side, what does that then tell us about what the housing market, what that landscape will look like over the next several months?
Well, it's certainly a good news that more supply is being provided by home builders on the single-family housing starts. We saw the apartment construction actually decline somewhat. Maybe people are concerned about oversupply, but for the ownership market, the single-family housing start this year, that could be actually more new home sales compared to last year based on the trending condition, even though existing home sales are down by 20% due to the lack of inventory. But the builders don't have constraints on inventory. They just build it and create that inventory. So clearly implying that there are demand out there. People want to see more choices, more inventory, and people are responding to that.
What's the likelihood that they'll see that anytime soon, Lawrence?
Well, the momentum is good. So it's an incremental growth, but we really need to see a big increase in inventory. Currently, we have only 1 million homes on the market. Pre-COVID 2019, we had 2 million homes on the market. So essentially doubling in the inventory is required, which is the reason our organization is talking with Congress to say, can we provide some tax credit for mom and pop real estate investors, small time, who are holding maybe 5 properties, to say, unload 1 or 2 of those property onto the market, sell it to the first-time buyer, and one would get some tax credit. So trying to provide some incentive to bring more supply onto the market.
Lawrence, when we talk about what the level of mortgage rates should fall to or need to fall to in order to spur some of that activity, are we talking below 6%? Because ever since we've gotten near these 8% numbers, we certainly have seen a further freeze of some of the activity in the market.
Yeah, Federal Reserve is clearly overdoing the rate hike. I mean, they are breaking clearly on the commercial real estate side, but on the residential side, the affordability, the monthly payment to buy a medium-priced home by middle-income person has essentially doubled from pre-COVID to today. I mean, this is taking away the American dream, the dream of ownership opportunity. So we need to assure that mortgage rate trends downward, and that can only happen if the Fed essentially say, we will stop raising rates, and once the inflation is clearly under 3%, we will start cutting interest rate. So I think that trending, will begin to occur in early spring of next year, but I hope the Fed begins to make those announcements.
What type of new inventory, and we've kind of focused in on where there's inventory coming on the market from the existing side, but what about on the new inventory side, where you've got fresh build-outs or even an order backlog that many of the larger home builders here in the U.S. are trying to work through, even in the face of some of the orders that are kind of off of the levels that they had seen last year in a more favorable environment, as it may have been and as it was, even though rates were still in the Fed's kind of rising and the early side of their rising policy?
One interesting trend line that I'm seeing is that the housing start is the beginning, but when does it finish? Usually it takes about 6 or 7 months. That's the usual time length. But what we are finding now is 9 to 12 months, clearly implying that there could be some regulatory barriers at the local level. We need to remove any barrier that hinder the construction activity because we need more supply coming onto the market. And we should also consider, training Americans to go into construction industry. repair things, make things, rather than go to university, because we may have too many people going to university and not enough going to trade school, because lack of construction workers is also hindering some of the supply factors.
Lawrence, you've been covering the housing market now for some time. Just what's your assessment of what's going on today, how unusual these dynamics are that are at play? I mean, you talk about the fact that we've seen a massive surge in mortgage rates, yet we haven't seen any relief, much relief in home prices, given the fact that there's simply just no supply.
Yeah, so lack of supply is driving the prices. So multiple offers still happening, perhaps not as intense as what occurred, say, 1 year ago or 2 years ago, but it's still happening in the marketplace due to the lack of supply. We did see some price decline out in the West region, Rocky Mountain State, California, state of Washington. But once the prices declined somewhat, there was a rush of buyers coming in. So right now we are seeing across all 4 major regions and across the country, South, Midwest, West, Northeast region, prices are rising. So this is clearly implying demand is out there. We just need more supply, even though mortgage rates are high.
And then just the average bidding that's going into this as well, Lawrence. How prepared should people be for the amount of bidding that they need to do and perhaps a percentage increase on top of what they're even offering?
First, you are absolutely correct. From consumers' perspective, it's not an easy market. First, people who still qualify for a mortgage, because at higher interest rate is a shrinking pool of eligible buyers. But due to the limited supply, one has to be ready. Get that mortgage pre-approval. Perhaps do some home inspection with personal eyes rather than trying to put that into a contingency, because as a home sellers, they don't like those contingencies, and they would go with someone who are saying, okay, anyone who bypasses appraisal contingencies, home inspection contingencies, it makes the offer more attractive. So something to consider, even though there are some little risk there, but given that there are so many buyers out there, one has to be ready.
All right, Lawrence, always great to get your insight there on housing. National Association of Realtors Chief Economist. Thanks.
Thank you.
Well, NVIDIA shares taking another hit today after Citi cut its price target on the chip maker to $575. That's down from $630 a share. We're looking at losses of just about 3.5%. The company, though, Citi did maintain its buy rating on NVIDIA. Now, Citi wrote, quote, "We believe the scope of the new performance density thresholds will make it difficult for NVIDIA to sell to China." Certainly some cause for concern there just about exactly what that means for NVIDIA's business going forward. We mentioned the fact that the company, though, still has that buy rating. They did cite a, quote, secular AI growth, which remains in the early innings. Some of the reason why they do see upside potential from where NVIDIA is trading today, right around $425 a share. But again, this just points to the crackdown from the Biden administration, what it means for so many of these companies with exposure to China, specifically some of the headwinds that are now facing the chip sector here, Brad. And when you take into account what Citi is saying here, saying that they believe that there's a low likelihood of the U.S. government granting export licenses to NVIDIA, that's the big reason why they lowered their sales estimates for the fiscal year of 2025 and 2026.
Yeah, exactly right here. And as you think about some of what this de-risking looks like, low likelihood of U.S. government granting export licenses. You mentioned the kind of cross-border implications here for anyone who is trying to bring online to the capacity that they've been able to deliver thus far, any more of that intellectual property, deliver that to the demand environment. But they also believe the new scope of the new performance density thresholds make it difficult for NVIDIA to sell to China, requiring more the networking modifications that it made on prior China products, notably the A800 and the H800 as well here. So that really being factored into some of their de-risking and China data center sales projections here that they're moving forward with. Shares right now, they're down by about 2.8% here for NVIDIA, and we'll continue to track them, of course, leading into that all-important week where some of those semiconductors report earnings later on during the quarter here. But as of right now, it has been one of the runaway stories here for AI annexed to NVIDIA over the course of 2023. Everyone, we've got all your markets action straight ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. As tensions heat up in the Middle East, strategists at Goldman Sachs forecast a fallout in the stock market. Joining us now to break down the potential impact is our very own Jared Blickery. Hey, Jared.
Hey there. Well, people are concerned about everything going on in the world, but they're looking ahead and probably a little bit prematurely to the Fed cutting rates. And Goldman Sachs is saying that's probably not going to happen in the way investors are expecting right now. And this is playing out in the yield curve as I have behind me. Now, just a primer here on the left side, we have the lower tenors, 1 month, 3 months, 6 months, 1 year. That's when the bills are due. And then this goes all the way up to 30 years. And this reflects the interest rates along that curve. Now, you can see that right now it's inverted. We have a situation of higher shorter term rates than the longer term rates. We can see them clearly greater than the longer term rates. All that means is that we have this inversion and there's a premium put on the shorter term. Now, this is important because we've seen the entire yield curve shift up over the last month. This lower line is where we were on October 11th. The middle line is where we were right before CPI. And now the purple line is where we are now. What this means is the market is pricing in fewer rate cuts. And what does that mean? Well, let me quote Goldman Sachs here. They're saying a prolonged period of geopolitical uncertainty coupled with a still inflationary macro environment is likely to eventually trigger growth concerns. Why growth concerns? Well, because the Fed has its foot on the brake right now, and that's what we're seeing here. Fewer rate cuts means higher for even longer, even higher for even longer for that matter. So all of this is to say we're in a very precarious situation. War and geopolitical unrest is highly inflationary. We can see this playing out in the commodities markets. We saw crude oil spike to $95 per barrel recently. Here's a chart of a year to date, and we can see it's off of those highs right now. But all of this feeds into a cycle. And let me just point out what happened in the great financial crisis. This is crude oil. This is what happened in early 2008. It spiked all the way to $150. This is very late cycle. The Fed was already cutting rates and the crude oil was still heading higher. And then something broke. In fact, a lot of things broke. So given the growth concerns, given the inflationary environment that the Fed is trying to fight, but also with the headwind of geopolitics, which is increasing inflation and the likelihood of it, it just puts the Fed and the global monetary leaders in a very precarious situation.
All right, Jared, thanks so much for breaking that down for us. Again, crude moving to the upside today, just above $87 a barrel. Let's get to another mover, and that's Procter Gamble. They reported better than expected earnings in its fiscal first quarter, seeing $21.87 billion in revenue on earnings of $1.83 a share. Yahoo Finance executive editor Brian Sazi sat down with P&G CEO John Moeller this morning and asked him about the company's commitment to its brand portfolio and what they call competitive superiority. Well, let's take a listen to what he had to say.
We've focused our portfolio into 10 categories, daily use categories, where performance drives brand choice. And if you're going to play primarily in categories where performance drives brand choice, you need to perform. And we're continuing to invest to deliver value to consumers through better performance and increase that margin of performance advantage quarter by quarter.
Within the big investments you're making, John, where are some of your biggest bets being made right now? I tell you, I look at that healthcare result, and I imagine that's in large part because of new tooth whiteners. But what else are you seeing in that business?
Well, let me just talk first to the breadth of the progress that's being made, because the great news here is it's not just one category or one product line. So in the quarter we just completed, 7% organic sales growth. Home care grew in the teens. As you mentioned, healthcare was very strong, double digits. Feminine care, oral care, fabric care, hair care, grooming, all high single digits. Baby and family care in the mid-single digits, and skin and personal care in the single digits. So this strategy and our innovation efforts, our brand building efforts, our customer support efforts are working across the portfolio. You asked for examples, a couple of examples. One, Dawn Power Wash, which has grown the Dawn business 50% since it was launched. Dawn has accounted for 90% of the category growth, which is a great bonus for our retail partners. And we've built a significant share, about 10 points over the last 3 years. So that's just one example. Another example would be Ariel pods, the 4-chamber pods in Europe, combined with the IXIC package, which led to 25% growth in a very mature category, fabric care, in the last quarter.
Do you not see consumers struggling, John? I've been talking to a lot of the food players, and of course another consumer staple like P&G, but of course they're selling food. And they're seeing consumers focus more on value and lower price points in private label brands. I mean, realistically, from your lens, how stressed is the U.S. consumer?
Well, I can only really speak intelligently to their behavior within the categories in which we compete, and they're continuing to buy our products. Our market share in the quarter that we just completed, for example, in the U.S. was up 50 basis points from a value standpoint, 60 basis points on a volume standpoint. Our global aggregate share was up 40 basis points. And if you look at private label shares as a measure of trade down in the U.S., it's really only relevant in the U.S. and Europe. In the U.S., 16% market share pre-pandemic, today 16%, very little movement while we've been building share. And why is that? How does that happen? It happens through the value that's created for consumers with superior performing products in categories where performance drives brand choice.
From an economic perspective, is there, a series of data that you watch that would suggest the economy is okay? For example, we just had a much better than expected jobs report. Is that a good indicator of how people are able to spend a little bit more on P&G products?
It is. We obviously look at retail sales and overall GDP. It's been a little bit of a mixed picture across the globe. But overall, again, when it comes to buying P&G products, the consumer continues to be very loyal.
You're also calling out in terms of guidance, so reaffirming your earnings outlook for the fiscal year, but calling out an $800 million benefit from commodities, but oil's back on the rise. I mean, do you think you can hit that number? How confident are you?
Well, we've provided for a range for general volatility and a range of outcomes within our guidance range. That's why we have a range. And while commodities have been a help, foreign exchange has been a hurt, exceeding the amount of help from commodities. Interest rates are a hurt. And it's why with a strong quarter, we're continuing to hold our guidance range on both the top and bottom line, because there is a certain degree of volatility and uncertainty in the world that we live in. But we are acknowledging that the first quarter was very strong, puts us on a very solid path to deliver against those guidance ranges, potentially at the higher end.
Within your guidance, look, you've appeared to have continued success with higher prices. Are there more price increases planned?
I really can't comment from a legal standpoint on future pricing plans. What I will tell you is that our volumes continue to hold up. If we look at the last quarter, plus 3% in the US, plus 2% in Europe. Some of our big enterprise markets, Mexico, Brazil, India, strong volume progress. So we're happy with where we sit currently.
Better than expected growth results out of China, John, here this morning. Do you see those results being reflected in yours? It looked like you called out some weakness in the SK2 line. I believe that plays in China, but what are you seeing there?
Yeah, we're seeing kind of a choppy market in China. There are some good signs, but generally the market hasn't grown out of COVID like people had assumed it would. We were pretty clear that we didn't see a linear path forward. And then specifically on SK2, purchase in China is being affected in the short term by the dynamics associated with the Fukushima wastewater release in Japan, because SK2 is produced in Japan. But overall, we continue to be very encouraged by the prospects in China. Despite the choppy market there, you've seen the aggregate global results, which are absolutely fantastic. And that's true, by the way, not just on the top line, but the bottom line. 17% earnings per share, core earnings per share growth, plus 21%, excluding currency. And that's all while significantly increasing the investments in our brands.
John, of course, you lead a very visible global company, and compared to 3 months ago when I last talked to you, it's a increasingly risky world in light of what is happening in Israel, between Israel and Hamas. What has been your message to employees the past week while this has been unfolding? And then does this change how you lead a company like P&G for the next couple of years?
Well, first and very importantly, we condemn violence in any form. When crises exist, we have a clear set of actions that we take, that we're following in this situation. And that is first and foremost supporting the health, safety, and well-being needs of our employees and their families, working hard to ensure that product continues to flow into the market in these daily use essential categories, and supporting humanitarian efforts, both with donations of products and other resources as needed. So we're focused on what we can do on the ground to make the situation better, doing the things that we know how to do.
And our thanks to Brian Sozzi for that interview with Procter & Gamble CEO John Moeller. All your markets action ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Live from the Nasdaq market site in New York City, Lululemon made its big debut on the S&P 500 this morning. As we're tracking shares of Lulu lower by 0.9%, shares of the athleisure company are up nearly 30% so far this year. And our next guest is calling it the brand for the long haul. Adrienne Yee, Barclays Consumer Discretionary Senior Analyst, joins us now. Adrienne, a lot of people waking up or perhaps starting the trading day today now owning Lululemon, whether they decided to or not, if they own the S&P 500. And so all that considered, you know, what is the significance of this, not just for Lululemon, but especially for many who have been keeping an eye on the growth trajectory of this company?
Lululemon is at the sort of like this inflection point in its global growth story. So what we know is that the North American piece of the business for the past 16 years or so since they started the business has really been the massive growth engine. The great thing about that is that they're continuing to expand within the North American, their core market. were largely driven by the US through men's, through accessories, through footwear. But the big story here is that they have, trailing 12 months, let's call it about, a little over 6 billion in North American apparel sales. And primarily female. So they really dominate that side of the business. But the goal here is to double that, right, in their long range plan. And the way they're getting there is largely through international. So I know that people are a little bit worried about kind of China and the macroeconomic landscape there. But remember, they're in their very infancy stages there. Their unaided brand awareness in China is 3%. And they're continuing to grow that at 60, 70, 80% year on year.
Yeah, Adrian, those comp numbers, growth numbers were very impressive. More than 60% growth in China in its most recent quarter. International as a whole up just about 52%. When you talk about that future opportunity there, I guess, what do you see those growth trends looking like? Can it maintain very impressive numbers like they have been putting up on those year-over-year comparison basis?
Yeah, so let's put it into perspective. Over the past couple of years, so during the kind of COVID ups and downs within China, Lululemon made a concerted effort to open, a good portion of their new store growth. So it's about 40% of their new stores in the prior year, and last year, in the prior year, it was a good third of their new store growth was in this market. And what essentially was happening there, they were getting advantageous rents, but of course, there was no sales return on those boxes. What they're now starting to see is that they have a roughly mid-teen kind of footprint, right, square footage footprint in the China region, but their sales are only in the low double-digit range. So there's a huge catch-up, right, of those boxes that are now starting to become really, really, truly productive. And as we like to say, these fixed cost leverage, brick and mortar rollouts, they tend to do very, very well. And you kind of see that big pop in that four-wall margin once you start to see those sales really start to accelerate. So it's open road for them there.
They're in the midst of this power of two, I think it is, strategy here. Product innovation, guest experience, market expansion, trying to get to $12.5 billion by 2026. And if you were to think about what they need to get right in order to see not just that marker, but then exceed it and set a new bar or baseline that investors and analysts like yourself should expect and grade them on, what do they need to get right? Is it footwear? Is it expansion into kids, perhaps? What is that key element?
So, Brad, I'm going to say no to the kids. We've been there, done that. So that's going to be a no-no. But what I would say that it's not so much, we know that they're tapping into footwear. Footwear is a great add-on to the brand. It's a highly, highly competitive atmosphere, as you know, right now, and it always has been. So kind of completing the outfit, right? I don't expect them to necessarily be performance competitive, but it really does finalize that kind of head-to-toe accessories. So what I would say more broadly, right, thinking about this more broadly than say, what category do they need to get right? Because that power of 3 times 2 strategy, right, it has all these different sort of tentacles into geo growth, category growth, men's, women's growth. Any one of those can kind of ebb and kind of like, go faster at any point in time. But the key here is that this is led by Calvin McDonald in the C-suite, and it's all about innovation and growing TAM. And what I'd love to say about Lululemon is the secret sauce is, yes, it's in the brand. Yes, it's in that iconic Omega kind of icon, right, that you want to wear. But the secret sauce is really in this continued long-term investment in the 3, 4, 5-year innovation, right? So they never stop innovating. They never think they have enough. They never think they're winning enough. And so what I would say is it's really about innovating in all these different avenues. And what you see most recently is the partnership with Peloton. Now, the studio piece of the business is really not, it's supposed to be less than 5%, that along with footwear, part of this plan. But again, they're always thinking about what does the next 3, 5, 7, 10 years hold in the direction of travel for the consumer.
Yeah, look, I mean, if next summer is as hot as it was this past summer, I might have to wear some of those rest feel slides on over to the set right now, or once we get there. because it was scorching. Anyway, our team doesn't need to see me in slides. But regardless of what Lulu is doing, Adidas, a totally different beast out there. You've got a company that's still working through some of their Yeezy inventory. I mean, put this kind of into a broader view here for us. I mean, how is this company able to continue to kind of capitalize on that, even despite, severing ties and moving away from the artist formerly known as Kanye West, and ultimately now kind of having this stockpile of inventory that they just need to write down, but ultimately still get through?
So I think you're referring to yesterday, I'll call it Adidas's, positive pre-announcement on the quarter. I want to make a differentiation here, sort of a factual differentiation here between, say, sure, Adidas and Nike versus Lululemon. Lululemon is pure play, 100% direct-to-consumer retailer, right? And so, as you know, we've talked about the retail inventory cycle and wholesale kind of being, lagging behind that. So your Nikes of the world, your Adis of the world, Adidas, they're working through that inventory. And I think what you're seeing the first time is this factual positive pre-announcement from yesterday, a little bit better on sales, better on gross margin, and then better even so on the operating margin. I think it's starting to show you that the cycle, right, the cycle of destocking across the entire landscape of retail and then depleting that landed inventory from the heavy up inventory we saw, over the past 12 months. Even Nike on their past report finally got their inventory in check. I think that bodes very well for the entire retail distribution chain. And it is nice to see a pre-announcement that actually is positive.
That's true. You don't get much of that these days. It's normally typically the opposite. So I like that positive spin there. Adrienne Yee, always great to get your perspective. Barclays Consumer Discretionary Senior Analyst. Thanks, Adrienne.
Thanks.
Well, we got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. We're live from the Nasdaq in New York City. Well, September data proving yet again that the consumer remains resilient. U.S. retail sales rising faster than expected last month, climbing 0.7% despite the pressure of persistent inflation. But there are some early results that we're getting from consumer brands, including Procter Gamble and also Pepsi, showing that shoppers are buying less because of those higher prices. So here to tell us what this means for the broader market and maybe some of those investment trends that we could expect to see going forward, we want to bring in Lee Munson, Portfolio Wealth Advisors President and Chief Investment Officer. Lee, It's good to see you. So give us a better sense of the consumer staple trade. Obviously a massive underperformer since the start of the year, among the worst performers that we're seeing in the market here. Yet we have a data print after data point here that's telling us that the consumer remains resilient. So how does that position some of these companies that have been under pressure since the start of the year?
Well, I think we have to sort of separate out what these sell-offs are all about. There's a group of stocks out there that are selling off because of these GLP-1s. You know, it's the Norvo, it's the Eli Lilly trade, and they're concerned that people are not going to eat treats anymore. But then you have, and I think that's overblown. Then you have this other situation. Listen to what Dollar General is talking about. Dollar General, you know, it's a poverty trade, and they're having problems with their profit margins because people are not buying high margin potato chips. They're just buying toothpaste. So you're seeing on the lower end, there's definitely this erosion of these staples that people are buying. And we've been hearing about that all year. So then you pour some fuel on it with the weight loss drugs, and now we've got possibly an oversold market in some of those areas.
Okay, and so where are the biggest opportunities? What's your top idea in the markets right now?
Well, outside of Dollar General, which I know that's not, you know, they sell the staples, take a look at something like Hershey's, right? My son owns this. The kids love to buy Hershey's in October because they think that Halloween candy is going to boost sales. I don't have the heart to tell them that's not the way it works. But Hershey, you know, they've got the salty snacks. This thing is down, you know, double digits from its high this year. You know, there used to be a time, remember a few years ago, when a stock had a 2.5% dividend that was actually higher than a 10-year Treasury, and people loved it. And I think that over the next year or two, that's going to come back in vogue. The second thing that I like is rather controversial. It's cigarettes. It's Philip Morris. It's paying out a lot of its cash flow. It's paying about 9% right now. I think people don't understand that story. There's a lot of younger investors that think it's about some pivot to cannabis or some, you know, I think they're high. That's not what it's about. You have a population, while declining, still smoke these things. And what Philip Morris does, they say, listen, you know, it's not like we're reinvesting and trying to get more and more people smoking, even though they would love that, but they're paying out all that cash flow. And I think if you're looking for a staple where you have an understanding of how that market is going down, and an understanding of how it's slowly eroding, you can get your calculator out, do some calculus, and go make some money. So I think you have to separate those out. I'm really concerned about a Procter & Gamble going into next year, though. If we get an actual recession, even if it takes another year, people are going to look to trade down. And I think that's where, you know, you're going to have some issues. I'd rather, you know, look at something like a Dollar General to take advantage of those staples that people still want to buy.
Lee, what's your base case on a recession these days? We've had a massive surge in yield since the last time we talked. We had growing uncertainty over in the Middle East when we talk about geopolitical risk. Has that heightened the probability of a recession?
Oh, I think that it's not really a matter of, you know, everyone wants to talk about this if or when. I can only buy price. So, you know, I'm 48. I'm a CFA. I can do the math. Every indicator is telling us we're going to get a recession. That's why all these guys, you know, these old dudes on TV have been talking about a recession for so long. The problem is we have a tight labor market, and that could turn this into a softer, you know, situation. So here's what you have to do as an investor. A couple of weeks ago, we had that big sell-off early October. To me, that was pricing in a soft landing. Soft isn't good, by the way, but it's, you know, better than hard. So I bought that. What I want to see between now and the next 6 months is that the market prices in a recession. I don't care if we get a recession. I want to see it price it in, and I want to buy that pricing. And I don't want to pay up right now because the market is not cheap. We could get a Fed, you know, just saying something at some, you know, talk they have. We could get another quarter-point rate hike. But I think when you see rates go up like this, and the 10-year, you know, the 10-year is going above 5. I'm sorry to tell people, maybe not much that more, but you're going to be able to buy recession pricing. So again, let's not worry if we're going to get a recession. Our only concern is if the market's going to price it in, because I think the market's priced in about 19 of the last 13 real recessions we had since World War II. So it over-predicts. All it means is that if you buy that cheap price, if we don't have a recession, stocks go back to all-time highs faster. And if we do have a recession, you got some good deals.
All right, the 10-year sitting just about 11 basis points below 5 right now. We'll see exactly what that trajectory continues to look like. Portfolio Wealth Advisors President and CIO Lee Munson joining us here this morning. Lee, thanks for the time.
Thank you.
Absolutely. Only recently, the Activision-Microsoft deal was approved by UK regulators, the final stage to cementing the merger. Xbox boss Phil Spencer is calling out that delay in the approval process and the impact that it's had in the rollout of Activision's gaming catalog. Gamers shouldn't expect to see some of their favorites available until 2024. But that doesn't mean the holiday season is dead. Let's bring in Yahoo Finance's Dan Howley and Chief Gaming Officer to tell us what gamers can expect. Hey, Dan.
That's right, Brad. I will gladly take that title as Chief Gaming Officer. There are a number of games coming out in 2023 or have already. The fall season is basically their build up to the holiday season, which is the most important time of the year for these companies. Now, just to give you an idea, last year we saw a 5.2% dip year over year in overall industry revenue, according to Newzoo. This year, we're expected to see a 2.6% jump. So some of these games could help with that. Let's start out with some of the big ones that are out right now. We have Baldur's Gate 3, as well as Starfield. Starfield is from Microsoft. That's one of those games that came from its Bethesda acquisition, that $7 billion acquisition of that company that makes the likes of the Elder Scrolls and Fallout series. Starfield, one of its biggest IPs in years. Baldur's Gate 3 is kind of a sleeper hit that is blown up across the kind of gaming sphere, and it continues to do well. I've put way too much of my time into it so far. EA also has FC 24. This is basically their new version of FIFA. They dropped the FIFA name, which is because they just couldn't come to an agreement with FIFA, the organization. And so they're essentially moving forward with the same game under the FC title. We also have Nintendo. They're launching a new Mario game at the end of this week, Super Mario Wonder. That should help goose some of the Switch sales going into the holiday season. Perhaps we'll see some bundles with that. Sony is launching Marvel's Spider-Man 2. That's going to be massive for them. That's a game that's a follow-on to, you guessed it, Marvel Spider-Man, and you'll be able to play as the two Spider-Men, Peter Parker and Miles Morales, and there may be some Venom action in there as well. And then we also have the new game from Sega, Like a Dragon Gaiden, The Man Who Erased His Name. I just put this in because I'm really excited for it. It's formerly the Yakuza series. My wife has played a ton of them. We just sit on the couch and basically you beat up Yakuza members with motorcycles. Really fun game. I'm very excited. That comes out next month, November 9th. So a ton of titles that are going to be coming out for the holiday season, and a lot of time to dig a nice dent into your couch.
Dan, you can barely contain that excitement. We're feeling it from here. Are you gaming?
I'm not as much as I used to be. I would get back in if there was more Tiger Woods PGA golf, Dan.
There we go. That's all.
You got to play the Yakuza games. Play the Yakuza games.
All right, maybe we'll give it a try. You never know. All right, Dan Howley, thanks as always for breaking that down for us. Exactly why gaming's most important time of the year is right ahead of us. Well, we got to leave it there, but let's do one more quick check of the markets about 90 minutes into the trading day. Pressure still across the board. The Dow off just about 180 points. Nasdaq off about 1%. Akiko Fujita, Rochelle Akufo have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufa with Akiko Fujita. Here's a look at what we're watching this morning. Political chaos. The House Speaker race heads into its second vote as Representative Jim Jordan works to win over the ballot again. Will the seemingly unwinnable race reach a conclusion, or will lawmakers look to another option?
And call it a comeback. Lululemon makes its big debut on the S&P 500 following double-digit gains for the stock this year. So is the athleisure trend here to stay? We'll discuss.
Plus, stroke of genius. Netflix is officially making its play into live sports. Could this be a hole-in-one, or will the streamer stall out? We'll discuss.
Certainly going to be one of the questions being asked on Netflix earnings later today. But let's take a look at where the markets are right now. 90 minutes into the trading day, we've got the Dow down 179 points, the S&P 500 down 33, and the Nasdaq down 130 points. A lot of losses we're seeing among tech stocks, but two names we're focusing on this morning. United Airlines and Morgan Stanley both reporting their earnings out today, and you see those stocks both seeing some steep falls there. United on the back of softer guidance, as well as Morgan Stanley seeing its worst day since 2020 there. Concerns around weak performance for the bank's wealth management division. Taking a look at where Treasury yields are, we have seen those moving higher as well. The 10-year yield now back trading near 16-year highs, up about 5 basis points there right now at 4.9%. Well, oil prices are surging after a deadly blast at a Gaza hospital further inflamed already fiery tensions in the Middle East. Now Iran's foreign minister is calling for sanctions and an oil embargo on Israel. This comes as President Biden visits Israel to reiterate the U.S. support for the country. Joining us now with how this will all affect the markets, let's bring in Yahoo Finance's Inez Ferrer, tracking it for us today. Inez.
Yeah, and Akiko, that call by Iran's foreign minister to boycott crude for Israel really has sent oil prices higher. Also, President Biden's meeting with Arab nations that was canceled, that did not bode well for oil. Look, Iran's involvement when it comes to the Middle East conflict is really critical when it comes to the oil prices, because Iran produces more than 3 million barrels a day of crude oil. It exports almost 1 million barrels a day. And last week, we saw a lot of volatility. I'll show you on our Wi-Fi interactive board, a 12-day chart here for Brent crude for WTI. A lot of this volatility came about because of concerns that the Israel-Hamas war would expand into other countries, namely Iran. Now, as far as oil's movement today is concerned as well, though, we are seeing oil move higher off of data, inventory data. Crude oil inventory fell by 4.9 million barrels last week. That's according to the EIA data. There was also data yesterday that reflected a similar move as well. Cushing, Oklahoma inventories, those fell by 700,000 barrels, flirting with operational minimum levels. And what that indicates is that demand is going up. So virtually across the board, you saw inventories go down, except for jet fuel, by the way. Jet fuel inventories climbed as demand is weakening there. Looking at where we're at with energy stocks, because energy stocks have been moving higher. I'm going to show you a 3-month chart on our Wi-Fi Interactive. XLE up 12% over the last 3 months as energy stocks have risen along with crude oil prices. And a year-to-date chart shows you XLE up 5%, guys.
We'll continue to watch that as the developments continue with President Biden there in Israel. Thank you so much, Inez Ferrer.
Thank you.
Well, in a major hit to the chip sector, ASML Holdings saw bookings plunge 42% in its third quarter. The company, which is the only producer of the equipment needed to make the world's most advanced semiconductors, said it had to rely mostly on China as sales everywhere else dipped. Well, here with some more insight into the chip sector is Yahoo Finance's own Dan Howley. Hey, Dan.
That's right, Rochelle. There's this kind of ongoing story with the chip industry where we're seeing declines in some areas and huge demand in others. And really, it comes down to this difference between what we're seeing with AI chips and what we're seeing with other types of chips in general. And this kind of push that we're seeing on the AI side isn't having the same effect for the other side, where we see kind of general purpose computing and servers for companies like Intel, TSMC, Samsung, and others. So let's just kind of break down what's going on here with ASML. They're the company that produces the machines that actually goes ahead and allows companies to create chips. They use technology, the most advanced is a lithography machine, and that's where you're going to be able to create the most high-end processors on the market. Now, apparently what's going on here is orders for those machines are running low. China, though, had the ability to bring them in because they have the plants already set up to go that need these kinds of chips. And so these kinds of machines. And so that's why we're seeing that kind of growth out of China. There's supposed to be more growth coming from the U.S. As that CHIPS Act rolls out and we start to see more companies produce their own factories here. But some of them have been stalled or are running behind schedule, or are dealing with other issues. And so the machines just aren't ready to come to the U.S. The other side of the chip problem is that we had seen such a large decline in consumer spending because of high interest rates and inflation. So people didn't necessarily need to go out and buy devices, or even if they did, they were figuring, well, I might as well hold off for now and we'll see how things rebound or don't in the coming weeks and months. And so that's why we're seeing a decline in sales for consumer chips. The interest rates and high inflation obviously also impacting general server sales. Anything that's not AI really doesn't seem to be blowing up as much as it should, but we'll get a better read on how AI is doing when we get NVIDIA's results later next month.
Meantime, Dan, we are continuing to see AI or chip stocks down broadly today, extending the losses from yesterday. We saw some steep declines on the back of these additional restrictions that were placed on AI chip exports to China yesterday. What does that mean for a company like ASML? What's the broader impact here?
Yeah, look, I mean, they wouldn't be able to ship some of their machines to China. They would have to get some kind of registration or pass from the government, to be able to actually get them shipped over there. And so that's going to potentially impact their bottom line, though they're saying that it wouldn't have a massive impact overall. And this is kind of the phrasing that we're getting from other companies as well. NVIDIA had previously said that they wouldn't run into any real problems in the near term with the restrictions, although they said, if we can't get access to the Chinese market overall, it'll give us kind of it'll hurt them in the long term compared to potential Chinese competitors. So, it really comes down to how these companies can navigate these restrictions and how they can continue to work with the Chinese companies that want to get their products, whether that means producing machines that create chips that aren't as advanced as what are around now, or with chip companies, whether it means producing less advanced chips than are around now. NVIDIA's already tried this, but even those chips seem to be on the chopping block for shipment to China. So we'll just have to see if they can come up with other solutions to get around this.
Yeah, it points to some tougher circumstances, given that these restrictions are meant to make it a little tougher to navigate this environment. Dan Halley, thanks so much for that. Well, we are watching shares of Chinese EV maker BYD pop after the company said it expects its third quarter net profit to almost double, driven by record sales despite increased competition and a slowdown in the Chinese consumer. This news comes from BYD as GM announces it's delaying the production of its electric trucks at a Michigan plant by at least 1 year, citing slow adoption rates. So we are seeing a mixed picture here from electric vehicle makers. Rochelle, the BYD story is certainly a very interesting one. Impressive if, in fact, we do see those record sales in the quarter, given just how aggressive not just BYD, but Tesla and other EV makers have been in the quarter in their pricing to try and attract more consumers at a time when we have seen a bit of a pullback among those consumers. A company like BYD increasingly, yes, China is the largest EV market, but increasingly going to have to look outside. Europe is one they've really honed in on as they expand their footprint there to 15 countries.
It's true, because when you look at some of the price points for BYD, their cheapest EV starting at about $10,000, making it very competitive. But as you mentioned, not available in all markets. Their most expensive one, their higher end one, starting at about $150,000. But what BYD does have the edge in the ability to ramp up production. They're opening even more plants, production plants in China. And even regarding to the success, BYD credited this quarter's success to, quote, leveraging on its improving brand influence, continuously expanding scale advantage, and strong industrial chain-wide cost control capacity, demonstrating strong resilience. And so when you have as many models as BYD already has, when you compare it to Tesla, these are the top two EV makers in the world. Tesla still ahead, but BYD has been closing that gap steadily. But they did get into that sort of that tete-a-tete battle when Tesla started making those price cuts, which did also cut into BYD's bottom line. But because they do have that range of products available, it did still put them in a very good position. And they're looking very positive here. I mean, they've been trying to keep up with those price cuts. Tesla's still leading, though, in BEV sales globally. But, you know, BYD catching up slowly.
Yeah, I mean, one of the big benefits for BYD is that vertical integration we talk about a lot. They do control their own supply chain, whether it's the batteries or other parts. So that allows them to control the costs a little more. That's not something that Tesla has. But we talk about GM as well. It is something they are trying to build out as well with their, battery factories too. But certainly the company looking is kind of in a different outlook here, at least among some of these EV trucks that they've talked about. Higher price points for sure. And Rochelle, I keep wondering, this is the question that's asked within the EV market. I realize we're talking about a global market, but where is that next lever? Is it from sort of the sedans? Is it from the SUVs and the trucks that we have seen increasingly being pursued, at least in the North American market? Something still to be determined, I guess, because there's still a lot of market there to capture when you consider, what is it, roughly 10% right now of the overall auto market?
And I think people still want a better price point. Not everyone can afford a Tesla. Even with these new price cuts that Tesla has, people still, if they're going to dip their toe in the EV market, they want the infrastructure there and they want the pricing to make sense.
Yeah, infrastructure increasingly a big challenge in adoption. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, the market's certainly been faced with a lot of headwinds from sticky inflation, a surge in oil prices, and tense geopolitical situations. According to our next guest, the ETF market is still going strong with $135 billion in new assets and about $200 billion in equities, with tech and growth dominating the sector. As part of the ETF report brought to you by Invesco QQQ, let's bring in VettaFi financial futurist David Nadig. David, it's good to talk to you today. So money's still flowing into ETFs. People aren't necessarily staying on the sidelines. Where's that going?
Well, it's been an interesting year because we've had $1 trillion in money market mutual funds. That's been sort of this overhang of money on the sidelines, that classic phrase we always use. But inside the ETF market, what we've seen is a really strong bond market. We've seen huge flows into everything from 30-year treasuries to CLOs and junk bonds. Almost throughout the spectrum, we've seen strong flows. At the same time, we've had about $200 billion in flows into equities, most of that in the US. A lot of that is chasing the sort of indefatigable performance of the Magnificent Seven. It's been really hard to beat the S&P 500 again this year, up 15-16%. But despite that, we've seen a lot of flows into some more interesting pockets of the market. So it's a strong market. Investors are still participating. It's not going to be a record year in terms of ETF flows, but it's going to be close. And I think given what we've seen over the last 2 years, that's impressive by itself.
So then, David, Rochelle here, does it make sense that we're seeing these ETF flows still into tech and growth when a lot of people are sort of, flooding into these safe havens? Even if you look at gold's performance today, help us make sense of why we're seeing this divergence.
Well, some of it is that folks are really trapped in this risk on, risk off model where they're trying to figure out whether they want to be aggressive and bet on this economy, staying strong, staying out of a real recession, or whether they're trying to be more defensive. And honestly, it's a bit of a barbell approach. Obviously, that money market money is very much in the risk off camp. But meanwhile, when you look at where money's starting to get allocated inside the equity sleeve of ETFs, it's things like defensive income and small cap value. I'll focus on a couple funds here. Avantis Small Cap Value Fund, AVUV, has pulled in about $2 billion in new money over the last year. It's beating the sort of standard indexed version of small cap value with some fairly disciplined approaches to trading around the edges. But investors are really leaning into what would normally be considered a bit of a defensive play. At the same time, anything that's throwing off income out of the equity market as a kind of defense play has also been getting huge money. I'd look at something like JP Morgan's equity premium income product, JEPI, JEPI. That's, again, pulled in billions and billions of dollars this year already. It's just been an enormous asset gather. I think we're close to $30 billion in that fund. It had effectively none a few years ago. And the reason is because it's defense throwing off income. So even while it's underperformed the S&P 500 this year, it's pulling in tons and tons of money because investors like knowing that they have a defensive portfolio that's going to give them that kind of income. It's been so popular, it's actually spawned competitors from BlackRock and Goldman. They're not going to name them all the same way. It won't be Beppy, Jeppy, and Jeppy, but we'll see basically copycat products trying to chase this kind of money.
Speaking of defensive, Dave, where does fixed income ETFs, where do they fall in all of this? I mean, it's not something we talk about often in the context of ETF, but when you look at where yields are right now, touching closer to that 5% level, I imagine there's a lot of interest there.
Absolutely. I think the challenge there has been figuring out where to be on the curve. We've seen an incredible amount of money flow into things like TLT, the long bond treasury ETF. That's actually been a money destroyer. There's now been more money lost trying to bet on the long end of the curve than in all of the leveraged and inverse products for the last couple of years. It's really been something to see. I think smarter fixed income investors are looking for other opportunities. I think it's worth pointing out that in the US here, we're still in the bit of a rate hike cycle. Maybe it's not going to be a bunch more, but I don't think anybody thinks we're headed for cuts anytime soon. Meanwhile, in other markets, like say emerging markets and some developed international markets, they're already going into easing cycles. So there's a real disconnect between what's going on in the US market and elsewhere. I look at funds like XEMD from Bond Blocks. That's a US dollar emerging market debt fund. It's yielding about 2%, which doesn't sound great versus the rest of the market. But if you think that we're going to continue to see things like we've seen in Brazil, which is that easing cycle, there could be real pockets of long-term growth in those non-US bond markets. So I think it's time to think beyond the aggregate and start slicing and dicing a little bit internationally.
And so, David, digging into that then, what are some of the international ETFs that you're perhaps steering away from, that perhaps look attractive, but you still have some risk issues with?
I think it's, well, on the equity side, I think it's a little bit tough to get really excited about, say, the UK and the Eurozone. Inflation is much more of a problem there than it is in the US. I'm not sure it's completely under control. So I'd be a little bit skeptical of that. I think Asia is probably a little bit better. I'm very skeptical on China at the moment, but I think sort of other broad Asia, India, I think there's reasons to be excited there. I think the bond space is particularly interesting. I would be looking at international sovereigns, something like Vanguard's BNDX is a currency hedged sort of global bond portfolio. That's been a very attractive way to get some of that extra diversification into your fixed income. And as I mentioned, from BondBlock's XEMD, an interesting way of playing perhaps the frothier end of the market, the emerging markets edge. Not something you're going to put in the core of your portfolio, but maybe a really interesting satellite.
Well, certainly a lot of options there for people to pick from if they're looking nationally or internationally. Appreciate you joining us as always. VettaFi financial futurist David Nadig, thank you so much.
Thanks for having me.
All right, you're so welcome. All right, all your markets actions still ahead. Stay tuned. You're watching Yahoo Finance. The House is currently in session down in Washington, D.C. Republican Ohio Representative Jim Jordan has been working to win the speakership after he lost the first ballot on Tuesday. Now, this comes as reports suggest a vote could be held to install Patrick McHenry as the temporary speaker in order to pass legislation. And so obviously some of the options that we're looking at here, postponing the vote, which it seems like they're moving ahead with it, keep at it with multiple rounds of voting. Jim Jordan does seem committed to it, although he is also now saying that he supports sort of this dual questioning of still having the second vote while also giving McHenry these additional powers as temporary speaker until at least everything is resolved. It's interesting, obviously, Patrick McHenry was one of the people who helped negotiate the debt ceiling deal that ended up drawing the ire of the ultra-conservative part of the GOP, which ended up getting McCarthy kicked out. So at the moment, I think they're just wrapping up the quorum vote right here, which is basically they're taking attendance so they know exactly what the threshold is that that Jim Jordan or whoever is trying to become Speaker of the House has to reach.
Well, there's growing calls to empower Patrick McHenry, largely because the legislative agenda has been at a standstill until a House Speaker can officially be named. Now, there's two key things we've been watching in terms of what needs to pass through in terms of legislation. There's a supplemental funding for the war in Israel as well as Ukraine, but also November 17th, which is what we've had circled on the calendar. That's when the current budget runs out, the funding for the government budget runs out. So, the question is, how long will this take to get a speaker in place? And will that run into that deadline? Now, what's interesting to me is not only did Jim Jordan say, yes, we should hold a vote on whether to empower Patrick McHenry, he also spoke to reporters before going into this session, saying that he does believe that some votes, as in GOP votes, have flipped against him. So that doesn't necessarily bode well because he lost 20 votes yesterday within the House GOP. If there are additional votes that flipped against him, we're talking about another round of votes and a longer delay in getting a House Speaker in place.
And it's interesting, he actually lost more votes in his first round than McCarthy did in his first round. And of course, it took 15 rounds for him to get to that point, and a lot of concessions, which then, in a circular motion, put McCarthy back in the position to end up being ousted. You mentioned, obviously, the debt ceiling coming up again on November 17th. Potentially some of the powers, if McHenry is given them, would allow him to at least negotiate that, but still puts him in the same position as his predecessor. But it does buy them a little bit more time, I believe until the end of 2023, if he's made the permanent Speaker pro tem, which is something that has been supported by Hakeem Jeffries and the Democrats, who have been voting as a bloc. A very long shot could be a bipartisan sort of coalition between the two, but that also has very little chance of succeeding in terms of a speaker being had as well. But
yeah, I mean, the argument,
yes, obviously the ultra.
The argument against empowering Patrick McHenry is, of course, that if you do in fact give him the powers, that doesn't add to the urgency of getting a House Speaker in place. So still, I mean, a lot to be determined here, but I mean, I would argue, Rochelle, we have never seen anything like this before, right? I mean, Kevin McCarthy being removed, that was a first. There were arguments about having somebody in place a week from now. Here we are, way past that, and still really no clear indication that Jim Jordan or somebody else will, in fact, have the votes, the 217 votes necessary to be able to secure that position as House Speaker. So we're going to continue to watch that live feed as we see the House gather to vote on that. Round two is what we're looking at right now. All right, after retail sales smashed expectations in September, it is becoming clear just how resilient the American consumer is. Shoppers aren't projected to slow down anytime soon, heading full steam ahead into the holiday season. According to Deloitte's holiday retail survey, the average shopper intends to spend just over $1,600 this season, surpassing pre-pandemic numbers. With more on holiday shopper habits, we've got Lupin Skelly, head of retail research at Deloitte. It's good to talk to you today. That $1,600 number, though, is that just higher prices built in?
Yeah, there's a couple factors going on. The past couple years, consumers have really been holding back and being a little bit cautious. This year, they're definitely baking in inflation. They're budgeting for higher prices. So that's part of it. The other encouraging sign, though, is that we've seen participation rates come back to kind of normal levels. So back in 2021, we were down to 88%, and this year we're back to 95%.
But then you have to figure, in terms of the economic environment, things like student loans kicking back in, still high inflation, what is motivating people to even want to spend more in this environment this holiday season?
Well, I think the past couple of years, like we talked about, people have had to hold back. They were just kind of waiting to see, and we've kind of missed out on some of the fun parts of the holiday. So it's interesting. We're seeing people say they're going to be spending more in non-gift categories. So the past couple of years, people have been purchasing gifts and kind of checking the box there. This year, they're excited and they're looking to kind of replenish decorations, home decor, and party apparel. So I think it's a good sign that they're feeling okay about the environment and are willing to spend in these categories.
It's interesting when you talk about the shopping duration that you're looking at when it comes to the holiday season. We had a guest on yesterday who was saying consumers are shopping earlier, starting now, thinking ahead to the holiday season. I mean, which one is it? What are you seeing? What's that window look like for retailers to be able to engage with consumers?
Yeah, it's a really interesting question. So, in the past couple of years when we had stockouts, we saw sales really get pulled forward into October because people were concerned about getting gifts in time. Now we have a different environment, right? We have inflation. We also have an increase in the amount of promotions that are happening in October around those prime days. So it's definitely keeping sales in the October area. We saw similar participation rates compared to last year. But what we're finding is that consumers really are kind of going back to those 2019 levels. They're planning to spend the most part of their budget during that second half of November and into the first part of December. So kind of like those normalization of trends. However, what they're saying is because they're buying fewer gifts, they're going to fewer stores, they're expecting that window of shopping period to come in almost about a week and a half from 2019 levels.
And I want to ask you about an interesting stat that I saw in here. Nearly 30% of shoppers will be responsible for about 70% of holiday spending. So who are these shoppers and how can retailers really tap into that?
Yeah, we wanted to kind of do an analysis and understand like who is responsible for the majority of holiday spending. And what we found is there's a group of about 30% of the respondents who are spending over $2,100 this holiday season. Like you mentioned, they'll represent about 70% of the holiday spending. They've got some interesting sort of demographics. So it's equal men and women. And what they prioritize is quality over price. So that's a little bit different than our the average consumer. They're also early shoppers. So they're jumping on in October. So there's opportunities for retailers to kind of promote early with this group.
You mentioned quality over price, but we have heard increasingly from retailers that it is about value for the consumer right now in this environment. How steep are the discounts likely to be if that's the case?
Yeah, what we found is that consumers are really going for promotions this year. Obviously, they're dealing with higher prices every day. So they're like, if we're spending, we're going to buy it at the most, the best discount. And they're anticipating that to be around Black Friday, Cyber Monday. We've seen participation rates skyrocket this year. So 66% of our samples said they're going to be purchasing during that week. And that's up from 49% last year. So these deals and this time period are super important. Retailers are going to have to differentiate themselves during this environment because this is the majority of when people will be purchasing.
And it's interesting, some of those purchases in some of the data that you were showing about how retailers can tap in, self-gifting, something I'm sometimes guilty of when I'm shopping for other people for the holidays, but also the kinds of gifts people are giving. Gift cards really becoming a lot more prominent this year.
Yeah, it's interesting. When we asked people where they expect higher prices, they said apparel and food and beverage were kind of number 1 and 2 spots. And what we're seeing is people are kind of pulling back in those categories and shifting into gift cards. So people plan to spend $300 on gift cards this year versus $217 last year. What we think is happening is that they're putting the inflation pressure onto the gift recipient.
Fascinating stuff there. I'll see what my budget is looking like as I head into the holiday shopping season. Appreciate that update. Lufin Skelly, Head of Retail Research Leader at Deloitte. Thank you so much.
Thank you.
All right, now for today's chart of the day, prepare to be influenced. For the first time, TikTok has surpassed Instagram as the most popular influencer marketing channel, with 56% of brands working with creators on the platform. That's according to data from a benchmark report from Influencer Marketing Hub. And the power of influencer marketing extends beyond Gen Z. Almost half of millennial and Gen Xers say social media is the #1 way they discover new products over in-person shopping, TV ads, and web ads. it's interesting because I thought a lot of people had sort of soured on influencers at a certain point because, it was a lot of, promotion and everything like that. And it seemed to be less about engaging and sort of being authentic with people. But when you look at these numbers here, people are clearly being influenced, especially as we head into the holiday season.
I mean, I am guilty of it, Rochelle. I am on, I tend to do Instagram more than TikTok, but whether it is recipes, shopping, finding brands, stores, I mean, it really is in that feed. And the discovery of all of that is, I think, what keeps bringing users back. It's interesting to me to see the TikTok influencer because I was looking at the user bases right now. Instagram has more than double the user base that TikTok has. But I guess the point is just the impact, right? The influencer, the engagement that TikTok has. 1.1 billion users versus the 2.35 that Instagram has. I don't know. What have you discovered on these apps?
So I tend to use TikTok almost like a search engine. Like if I want to try out a new hairstyle or I'm going to a new city, that's usually where I start because I feel like it's just easier that way. And then in terms of where I'm more likely to buy from, I do tend to buy more from Instagram. I don't know why. I just feel like some of the things on TikTok just seem a little bit flaky. When I'm sort of looking at it, it's like a trend for 5 seconds and then they're like, oh, actually this doesn't work. Whereas I don't know, Instagram, I feel a bit more loyalty there. So I think if anything, it's more
feed,
Instagram made me buy it.
Yeah, yes. It's a cleaner experience on Instagram. But as we always say about TikTok, the algorithm is so good that the element of discovery, you could argue, is probably there more. But Instagram has sort of been ahead on the shopping side. I'd be curious. I mean, TikTok has really, really gone all in increasing that engagement when it comes to shopping on the platform. And they've made some huge inroads there. So a year from now, what are the numbers going to look like? We'll have to see, but we'll do our part, right? We'll do our part to keep the engagement up.
You know it.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Lululemon officially joining the S&P 500 index today, replacing game maker Activision after recently finalizing its merger with Microsoft. Now, this comes more than 15 years after the athleisure retail company made its public debut. Yahoo Finance reporter Proctor Gamble is here to discuss how Lululemon got here, one stretchy pant at a time, I guess.
That's right, Rochelle. One stretchy pants at a time, of course, evolving so much from being a leggings brand to now an athleisure powerhouse. When you think of this company, you can't help but think of its signature leggings that kicked off back in the 90s to today, known for so much more, like those belt bags most recently. But the company has had some hiccups in the way. Compared to a decade ago, in 2013, the company was known for something much different. Back in 2013 is when Lululemon recalled about 17% of its black yoga pants for apparently being too sheer. Now, that cost the company roughly $60 million in lost sales at the time. And then following that, founder Chip Wilson had said some pretty offensive comments that some women's bodies don't work for the pants. He then resigned in December of 2013, and Lululemon's share price dropped by roughly a quarter in 2014. And following that, the company faced yet another leadership scandal before current CEO Calvin McDonald took the helm in 2018. And since 2018, despite all this noise and all these changes, they were really able to hit a stride and pick up momentum. And one analyst calling it incredibly successful as it defied all the pressures on retailers. And ways that they were able to do that is by investing in digital sales. We also saw them double down on menswear, as well as invest in other what they call play categories like tennis, golf, and hiking. And it's important to note now that you're seeing this momentum build up. You're seeing them join the S&P 500 at a time where in the last year, shares are up nearly 40%, despite consumers feeling the pinch of inflation. And one analyst telling me from a long-term perspective, this is a sustainable growth story. And so it'll be very interesting to watch just where Lululemon goes from here.
Brooke, you just highlighted some of the products that have really helped drive this stock higher, but Lululemon's always been about sort of this lifestyle brand, right? Selling an image, selling a lifestyle. What are the other growth drivers you think the brand can lean on moving forward?
Yeah, Kiko. Well, analysts really weighing in on three key growth drivers here. And as you noted, the brand has always really been this lifestyle athleisure wear, but most recently with the rise of athleisure wear, Lululemon really winning here. Analysts saying mostly that now, and we know this as well, it's perfectly normal to wear leggings to things like work and school, and Lululemon stepping perfectly into that. The company also investing in non-athletic wear like those belt bags, which are then picking up as a trend among multi-generations. That really brings me to my next point, is his ability to be a selling point for both men and women, as well as multi-generations. As I said before, they introduced men's casual pants back in 2014, but since then, they've wanted to double down to drive growth there. And Lululemon's remains a key brand among upper income teens, according to the recent Piper Sandler survey, alongside its core customer base of 35 to 55-year-olds. And another key driver that's important to watch here is while they didn't do so well in their launch in Europe, many analysts banking on this launch in China. The company aims to quadruple its revenue, international revenue, and make China its number 2 market. And it is important to note that this all comes as that consumer's wallet does remain pinched, but many believing that their higher income audience are willing to pay that premium price for their yoga pants.
Okay, we'll be watching if that continues. Proctor Gamble putting it all together for us. Thanks so much. Well, shares of Procter Gamble are seeing a lift in the session today. P&G earnings topping expectations and boosting their full-year outlook. CEO John Mueller, speaking to Yahoo Finance earlier today, talked about what he sees in consumer choices now.
Well, I can only really speak intelligently to their behavior within the categories in which we compete, and they're continuing to buy our products. Our market share in the quarter that we just completed, for example, in the U.S. was up 50 basis points.
Consumer staples still one of the worst performing sectors of the year. So what can we expect from consumer and personal goods? More on this. We've got Peter Grum, UBS household and personal care analyst. Good to talk to you today. Let's start by talking about P&G results. Sales largely driven by those higher prices that they implemented. I'm wondering if they have seen the ceiling on that. What are you seeing in consumers and their willingness to continue to pay up for these products?
Yeah, thanks. First off, thanks so much for having me today. I'm glad to be here. I would say, to that question, I would say on list pricing, I think it's going to be harder and harder for, additional increases, both from a consumer perspective, but also just from retailers pushing back more and more. But that's not to say that, consumers won't trade up. I think one of the things that P&G has done exceptionally well has been, innovation. And through innovation, they've been able to drive, brand choice because the performance is superior to others. And that causes consumers to trade up, particularly if there is a perceived benefit, relative to the competition. So even though list pricing may become more and more difficult as we move forward, that doesn't necessarily mean that consumers will not trade up looking ahead.
And so how much upside do you think there is for P&G versus some of its competitors?
Look, I think one of the key things that is going on with the consumer staples right now, beyond kind of the rate dynamics, beyond GLP-1, is just more around the composition of organic revenue growth. And so what we've seen across the group over the last several years, to the point earlier, is that a lot of the organic revenue growth has been driven by pricing. However, Proctor this morning might have, reported a volume decline that was somewhat disappointing, but that was largely a function of weaker performance in China and their SK2 brand. And in fact, many markets around the world, US, Europe, even in Latin America, they're actually seeing a return to volume growth. And I think, investors are going to be willing to pay a premium for that volume growth. So, while the shares have held in better, versus the large cap multinationals, we still think there's room to move higher.
When you talk about that return to volume growth, you look across the sector, who do you think is best positioned right now?
I think it's a great question. I would say there's within household products, I think Procter Gamble is well positioned. I also think Church & Dwight, given their value tilt to their portfolio, is likely to see a return to volume growth, this upcoming quarter. And I think Colgate, maybe not, more best positioned from a U.S. perspective, but they have a lot of exposure to emerging markets, and they're doing well in markets like Europe. So I think those would be the two other HPC names that I would highlight. I think outside of HPC, I think there are a number of beverage companies that are already seeing volume growth: Coca-Cola, Constellation Brands, and Monster, to name a few.
So then in a higher for longer environment, I mean, we heard them talking about on the call there, unfavorable foreign exchange rates now expected to be a headwind of approximately $1 billion after tax. How much longer can P&G sustain that in this higher for longer rate environment?
Yeah, what I think is, what kind of gets lost in all of this is, in many cases, a lot of these FX headwinds, or the incremental FX headwinds, are a result of, strengthening of the dollar against, certain emerging market countries where the consumer is used to kind of hyperinflationary periods. And so in many cases, companies like Procter & Gamble and Colgate and Coca-Cola can continue to take pricing in these markets. And look, the consumer in these markets typically tend to be more used to it. I think, in more mature markets, like the US, like Europe, I think it's probably going to be more and more difficult to take, more and more pricing. But in a lot of these, categories, they are everyday use categories. Consumption should improve, as pricing moderates. So I think they can sustain this. And it really comes down to their ability to continue to gain share, which in that clip you showed earlier of John Moeller, I think that's kind of the point of differentiation. They are driving category growth, and they are gaining share within, the categories in which they compete.
Peter, we've heard from retailers over and over that it is about the essentials right now at the expense of any discretionary spending. That would suggest upside for a company like P&G, and yet we started the segment by talking about this is one of the worst performing sectors so far. What are some key names here in the sector that you think could really see some significant upside, at least in the short term?
That's a great question. I think you've had this kind of perfect storm of events, if you will, that's really driving the weaker performance of consumer staples. I think last year, even though rates were rising, I think the market was more positioned with the defensive tilt. And I think we're kind of seeing some normalization of that. And so I think people and investors more broadly are kind of thinking about what are the right multiples to be paying for these consumer staple stocks with 10-year, hovering near close to 5%. And I think it's a fair question. And I think when you layer in that, the decelerating growth narrative we've been talking about as pricing benefits fade, and kind of this emerging unknown, if you will, in terms of what GLP-1 does to volume growth, and less so from an HPC perspective, but obviously impacting beverages and packaged food. I think the question really has become, or the difficulty has become, what's an appropriate valuation for this group more broadly? And I think to that end, when you have a uncertainty on the multiple, it becomes more difficult to figure out what's actually priced in at these levels. And I think to that end, we think companies where you are going to see either significant positive estimate revisions, so buy-rated ELF, buy-rated Celsius are ones where we think there are still room for estimates to move higher, or the composition of growth, meaning a return to volume growth, are the names that we think are going to, or the themes that we think are going to continue to play. And so in that, balanced growth, I think Procter is one that is going to get there in the next couple of quarters. I think Colgate is another one that I would highlight. And then on the beverage side, I think Coca-Cola would be another name that I would highlight as well.
Certainly a lot of nuance to keep an eye on there. Appreciate you joining us. Peter Grom, UBS Household and Personal Care Analyst. Thank you so much.
Thank you so much for having me.
Well, Netflix is making its play into live sports, announcing the Netflix Cup, an 8-hole golf tournament that will stream live on November 14th. Josh Schaefer is excited about this one. He's on the beat for us on the streaming giant. Josh, we spent the last few years talking about how Netflix would never get into live sports, right?
Yeah, Kiko. And Kiko, I think it's important to highlight here that is it really live sports or is it more like live entertainment? We're not really talking about a competitive sporting event here. I think it's a little bit more on that entertainment side when you have pro golfers playing with other athletes that play in a different sport and F1 racers. But I think it makes sense for Netflix for two reasons. One, we talk a lot about Netflix's ability to bring some of their characters to life with maybe like Stranger Things merch or sort of go that Disney route with being able to create their shows and their experiences and bring them in person to people and bring them to fans. This is happening the week that F1 is in Las Vegas, and this event is happening in Las Vegas. So for fans to be able to engage with their favorite Drive to Survive characters, I think is something to think about here. A golf course is much more of a friendly manner for people to basically banter and talk, right? That's what golfers love about golf courses. And I think that's what they're trying to bring out here. They mic up some of these F1 players or these F1 drivers and have them bring out maybe a little bit more personality. And the second thing is if Netflix were ever going to actually go to live sports, I'd rather test out live streaming on a golf event that, as we just highlighted, isn't really that big of a major sporting event than testing it out on, say, an MLB game, an NBA game, an NFL game that people are live betting on and all those different things going on, because we know from watching Apple launch baseball and these other streamers starting to get into live sports, it's challenging to stream live sports, right? And bring a lot of people onto a platform. Netflix even had trouble, I believe, with their Chris Rock special at one point with the amount of people coming onto the platform. So I think you might just see them sort of testing things out too and thinking, what if we did stream real live sports, competitive live sports, professional live sports? What would that look like? Well, let's test it out with F1 and some fun golf.
It's certainly a way to dip your toe without, risking it being, as you mentioned, an NFL game or something else. But what do you think this is going to tell us about the demographics that Netflix could be appealing to by dipping its toe in this way and building on some of the existing programming that it has?
Yeah, Rashad, you definitely would think that this would potentially hedge to a younger fan base, right? We know that F1 has been very successful with younger fans, and this really, to me, has more of an F1 appeal than it has a PGA Tour professional golfer fan appeal. I think it'd be more fun to see these drivers and hear them talk and be mic'd up during a golf event than necessarily see the golfers play in a less serious golf event. But I think it'll be interesting to just see who does watch it? How big's the audience? We're talking Tuesday at 6 p.m. Eastern here. I mean, maybe if I leave the office early enough, I'm going to check it out. But I don't know if I'm a watcher of this. Akiko, Rochelle, are you guys watching this?
I'm not watching it.
I think I might.
I got too much sports to watch, Josh. This is not one of them.
I agree. Yeah. I'd rather watch a more serious event, I think. But Rochelle, I know you're an F1 fan. I can see how it's fun.
You know, and plus, you know, all my other teams are doing terribly this season. So I'm like, why not? Let me throw my hat in here.
All right, we'll stay tuned. By the way, we should mention Netflix reporting earnings too. So we'll see if that question pops up. Josh Schaefer, as always, thanks so much for that. Let's do a final check of the markets before we let you go. Going into the noon hour here, we are seeing red arrows across the board. The steepest losses coming through in the tech sector, with the Nasdaq down 103 points, the S&P 500 down 31, and the Dow down 178 points. Of course, we are watching Treasury yields there, with a 10-year yield inching back to that 16-year high, or closer to that 16-year high. And of course, we got a packed earnings schedule here with Tesla as well as Netflix after the bell. We'll all be keeping close tabs on that. That does it for Rochelle and I in this hour. Thanks so much for watching. We'll see you right back here again tomorrow.